Those all-time highs
back
on
above,
US
back above 5,200 on the S&P. It's felt like more of an earnings story out of Europe this week than maybe out of the United States, but there has been an earning narrative that you need to put into the mix as well. And you do kind of, that feels like maybe next week that begins to fade a little bit. So we'll be back maybe to trading all the macro. So here we go. European equity markets are about to open. We're anticipating a positive start, a continuation of what has been a fairly strong week. In terms of the numbers, the FTSE 100 out of the gate, as anticipated, with a fairly positive start to the day. Let me just see if I can get you some movers, and then we'll know exactly what's happening here. In terms of points, this is where the weight is, so I'm going to give you the weight numbers. LVMH, Shell, CRH, Sanofi, Total, all tracking higher. LVMH is adding the most points on the upside. I need to check my dividend list in terms of what we're seeing on the downside, because there's Ducey Kuehne+Nagel down by over 3% this morning. I have a strong suspicion.
Yes, I think you're right with that one.
That may be on the divvy list this morning.
Yes, just pulling up that dividend list.
Anna's always on it. She's got the list ready to go.
Yes, Kuehne+Nagel, you're absolutely right. We thank our colleague Dan Tillies for keeping us honest on that front. Morning after morning. In terms of where we trade across these sectors then, Guy, we've got energy as a really strong performer. Dropping down the list slightly, travel and leisure actually, the best performing sector, and all sectors, crucially, in positive territory. So a sort of sea of green. IAG is one of those stocks that's doing well, up by 1.6% though. I mean, not a blowout performance, but that helps to lift that sector, the travel and leisure sector doing well. Basic resources having another day of strength. You referenced, I think it was the copper price earlier on, and copper prices were higher through the Asia session, so maybe that gives another lift to the M&A story, which is clearly strong there. The M&A force, strong with that one. And we've got the oil price going higher as well, up by 0.75% at 84.52. Perhaps that helping to lift the energy names.
May the 4th was a few days ago. That joke was a last week joke, not a this week joke.
It's very much a last week joke, and I probably didn't deliver it very well.
We're to see exactly what's happening with gilts. We're keeping a firm eye on what is happening there. This following the GDP print we saw a little bit earlier on, which was much stronger than anticipated. I say much stronger. It was definitely stronger than anticipated, and confirms this idea that the UK is out of recession. Does it confirm this idea that maybe actually we do need to see maybe some rate cuts coming through? I want to check and see exactly what these numbers look like, because here we go. We're starting to get, here we go. The UK is now open. So the front end, I mean, just readjust my screen so I can see what the 2-year is doing. Yeah, we are continuing to see things moving a little bit lower as anticipated, and what we saw yesterday kind of confirming that idea.
Yes, I mean, not a huge move, is there, in the 2-year? But maybe that's because it didn't really move. This is exactly what Pooja said to us earlier. The market kind of put aside Bailey's dovishness yesterday. This is the gilt market. And focused instead on the US. And therefore, there isn't too much of that dovishness to unwind today with a hotter print on GDP.
Sam Brown was joining us earlier. This was his take on what we're seeing with the data.
In terms of trying to communicate that the policy reaction function is different, both the ECB and the Bank of England have done that, in my opinion, quite successfully. And I think there's good reason to. They have a lot more confidence than the Fed that policy is sufficiently restrictive. But in reality, the ECB is saying it's going to cut in a couple of months. Bank of England's potentially signalling it's going to cut in a couple of months. So if we get to June and they cut, then that's really going to show the market that they are happy to have that transatlantic divergence.
Sam Brown from BNP Paribas Markets 360 joining us in the last hour. Joining us now, Damien Hill, who oversees UK corporate bond, strategic bond and inflation-linked corporate bonds strategies at Insight Investments. Good morning.
Good morning. Thanks for having me.
Talk me through the market, how you see the market reaction to A, the Bank of England, and B, the data that we're seeing this morning out of the UK.
Yeah, so absolutely. A little bit of a non-event, kind of as expected. So 8-1, moving to 7-2. Dave Ramsden joining Swati Dingara's cutting crew. And that band probably only going to expand over the next several meetings we have. So the area where we kind of disagree a little bit is those longer-term inflation forecasts, 1.9, 1.6, 2 and 3 year. Clearly, those forecasts further out pretty hard to make. And we'd see inflation remaining somewhat stickier, given the kind of newer impulses to inflation that we see in the medium term, whether that be more volatile geopolitics, with the UK being an open economy, kind of the dual deficit, current account deficits, as well as things like climate change. You've only seen that as well in the volatility and things like the cocoa price earlier in the year. Not saying that the UK is a massive consumer of chocolate and that's going to massively move things.
We are a massive consumer of gas, and that has been
absolutely,
going up.
absolutely. So there is that dichotomy there, clearly, with that medium-term inflation blue with the Bank of England coming down, but clearly this growth impulse is improving from that recessionary condition we saw later last year. Unemployment clearly rising, but from a low base, clearly not high in a historical context. Economic surprise indices moving higher, and you saw that probably with this GDP print this morning. So really some economic impulse there. PMIs still looking buoyant, and service sector inflation still elevated, and wage as well. So it's going to be tricky to balance those two narratives, and we see still our mantra is probably less in terms of cuts and later.
Okay, less and later. So can you put some numbers on that?
Yeah, so we'd broadly be in line with the market probably for the rest of the year, so 2-3 cuts. In terms of it remains to be seen whether they go in June. We'll see clearly the inflation print's coming up in April. May the 22nd, I think the next one is. Absolutely, so that becomes important, and the data dependency, etc., could kind of change the timing of first cuts, whether the ECB or the Bank of England go first. But we expect those two to go before the Fed, as outlined by Bailey's comments. There's no right for the Fed to go first. But in terms of a terminal rate, we only dare forecast out 1 year, given the different kind of volatility you can get in all the indicators. But terminal rate by the middle of next year for the BOE may be kind of 6 cuts, getting you to 3.75, something like that. So that's a little bit above consensus, that kind of later and less.
Okay, so the cutting crew grows. Nice.
Absolutely.
80s rock band reference.
Absolutely, I thought I'd say that in there.
Didn't escape my attention. Don't ask me about current music. But let's think about the corporate issuance landscape, which is, I know, one area where you focus. How much pain have we seen from the tightening cycle for UK corporates? How much of that is still to come? Or do they escape it? Did they lock in for such long periods previously during the sort of great moderation that actually a lot of them are unscathed by the hiking that we've seen?
Yeah, this is an interesting question. I guess for sterling investment-grade corporates, they have kind of pre-funded to a great extent. There is a large amount of the market, say, focusing on utilities that are constant need to issue. So clearly they have the transmission of higher kind of coupons and costs of them comes through more quickly. But broadly, the supply in the sterling market is a little bit light relative to demand. So we're seeing very strong technical demand for credit, higher yield environment. We've not seen these kind of yields consistently, these kind of levels, since the GFC and the tech bubble before that. So we're seeing a lot of demand from institutions and retail. There's a lot of, I guess, distortion, particularly at the longer end, in sterling credit from large institutional buyers, insurers, pension schemes. There's a lot of activity in the UK buyout market for DB, and that really only increases the demand as they immunise pension schemes and match cash flows, and they buy more credit. So there's a strong demand for UK credit further out.
So there's a strong demand for credit, and I guess if the GDP story continues as we saw it painted this morning, a quite positive trajectory for GDP, you're not too worried about defaults around the UK then?
No, we're pretty. We're seeing defaults as being pretty benign. One area in terms of as you go down the kind of rating spectrum where we are a little bit more cautious is with high yield. So you're seeing the lower end of high yield. Not that it's a massive part of the UK market. Real estate has been an interesting one. So you've seen certain names in the Scandinavian market fall through all the way from investment grade down through high yield, mentioning no names in particular. But so that's been a sector where you've really needed to get your stock selection right, and active management is key in these kind of areas. But in terms of the UK, a little bit less stress. It's not as developed high yield, but broadly we're much more cautious on high yield. Spreads are somewhat tight in our view from a risk-adjusted basis versus investment grade. So favouring an up-in-quality bias. Clearly, the lags of monetary policy still to come through. The Bank of England was stressing maybe 2/3 of it starting to come through in the UK. So, there may be some pain down the road in lower ends of the parts of the high-yield market. But IG, largely unscathed. It's not really a default story.
Let's come back to those lags. There is a conversation just beginning about when the next hike comes from the Bank of England? About how you need to think about how this cycle is going to evolve and how far, to your point, maybe the cutting actually goes, and how long the lag will be from the kind of the final cut to the first hike. Is that conversation beginning to become relevant? Am I too early in thinking about it?
Yeah, I think it's a bit early, certainly from our discussions. Clearly, the kind of thinking about whether the next move might be a hike is more prescient in the US, I guess. That's certainly been something more in the narrative.
Yeah.
In terms of in the UK, I think we're way away from thinking about when the next hike might be, certainly in our internal discussions. So it's all about how far they cut at this stage, and clearly we are a bit...
And presumably how far they cut determines how quickly they're going to be hiking as well. If they cut aggressively... and the economy proves to be more resilient than maybe than anticipated, the first hike becomes maybe more germane in terms of what we need to be talking about.
Absolutely. So hence why we are later and less, because we think the economy is improving. Our risk models are saying ultimately the impulse for growth more broadly is pretty decent. So yeah, we're not advocating massive cuts and back to anything like what we were seeing pre-COVID in terms of or around COVID in terms of levels of
I was
rates.
going to ask you that that great moderation and that period of very low rates, a lot of people concluding that this is a different era and we shouldn't expect to go back to anything like those levels. So what kind of rates do we settle at in the UK?
So as I say, in terms of our forecast period, terminal by middle of next summer, maybe 6 cuts getting us to about 3.75. Is our view. So we're not forecasting out further than that. We think it's a bit of a fool's game, 2, 3, 4 year. But yeah, we think that's probably a cut or so higher than the market, or less cuts, so to speak.
Right, and how restrictive would that be? I'm just trying to think of what kind of impact that's going to have on the parts of the UK economy that have not been thriving, because there've been some doing fine, but others, I'm thinking of real estate here, not doing so well.
Yeah, no, absolutely. I think it does remain to be seen. Clearly, if you take the Bank of England stance on those inflationary kind of medium terms, they expect, given that directionality on a domestic impulse, for that to be restrictive. So, yeah, in terms of real estate, probably is an area that might suffer a little bit, given a higher for longer in terms of rates, and that's our expectation. But clearly, there is that supply-demand. If you think about resi in the UK, there's always never enough supply. So, it's always been the full game waiting to buy a property, for instance, or from your domestic side of things. So, yeah, look, I think medium term, the expectation we would agree with from the BOE, they need to maintain that restrictiveness to get inflation under control.
What's the maximum spread you could see Bank of England to Fed? How far kind of down the road can they go?
Yeah, I mean, our forecasts at the minute, we're seeing kind of 3 or 4 cuts about a year out from the Fed. So given that, that's kind of, 3 or so cuts different. Clearly, they're quite close in terms of where the bank rates are at the minute.
Yep.
So something like that as a maximum. Clearly, the UK currency, there's quite a lot of negativity built in post-Brexit. So we don't think if they diverge or they go first, you're going to get a material move in the currency, with it already being somewhat depressed longer term.
Okay, Damien, thank you very much. Thanks for joining us. Damien Hill, Senior Portfolio Manager at Insight Investment. Let's focus in on one of the corporates that has reported numbers this morning. IAG shares are up after the British Airways owner reported that high demand for travel has been a continuing trend. Let's get more with Bloomberg's Sid Phillips, who's, of course, covering this sector for us. So, Sid, what bright spots are IAG flagging? What have you found?
So IAG has been flagging the fact that they have very strong transatlantic performance, as well as the fact that they've got very strong intra-European performance. IAG is the owner of British Airways, Iberia, Aer Lingus, and other carriers, and so they have a very strong transatlantic presence, both North America and South America, and they've sort of been flexing that advantage and talking about how that demand is really strong as they go into the crucial summer season.
Sid, O'Leary was cautious on the summer season. IAG sounds more positive. Is that the right read?
That is. I mean, O'Leary was less confident about pricing power in the summer season, but IAG is talking about how demand is strong. And they've said that about 80% of their second quarter bookings, forward bookings, are sold out. And they're about 40% sold out for the third quarter. So they do seem to be far more confident about demand in Europe this summer. And so I think that's really a sort of divergence in terms of where O'Leary stands and where IAG stands, really.
Sid, why the difference between, is it just the North Atlantic, between what we're seeing at IAG and what we're seeing at Air France and what we're seeing at Lufthansa. Why is IAG seeing a different picture?
So IAG is sort of telegraphing the fact that they are less exposed to both Asia as well as the Middle East, and that gives them a slight advantage over Lufthansa and Air France that do have a lot of services to the Middle East and to Asia Pacific, where competition is rising back again. I mean, we've seen the rise of sort of carriers both in Asia Pacific coming back from the pandemic, and that sort of brought in lots of capacity, and so pricing power isn't as strong on those routes. And so IAG is sort of saying that, hey, we're on the transatlantic route where we see demand continuing to go gangbusters.
Sid, great stuff. Thank you very much indeed, Sid Phillip, joining us on what we're seeing out of IAG this morning. We're coming up to IATA. There's a lot more aviation news coming up over the next few weeks. Looking forward to that. Let's get back to the shoes story, both for cars and for people. Joe Easton, back over to you.
So firstly, with the shoes in the car space, Pirelli, the tyre maker, this one gaining 2.5% at the open, coming down slightly now, volume growth continuing, the margins looking pretty good, not exposed so much to the EV space, which is where we've seen some warnings recently, but that one is higher. Salvatore Ferragamo, though, that one actually not doing too badly, down 0.2% at the moment. It has fallen a lot recently, given the downturn in some of the smaller luxury stocks. The earnings didn't look great, but they are saying potentially there has been a little bit of a rebound in Europe throughout the spring, so that might be supporting the stock, taking the edge off there. In terms of utilities, they are having their worst quarter versus the main market for around 20 years, according to an analysis I read yesterday. And we've got numbers out from Enel today over in Italy, and that stock coming back up around 2.5%. And finally, on the Italians, we've got Mediobanca, a massive jump in net interest income for that one today, so that one's getting a decent gain, one of the best performers. In terms of some other earnings, we do keep an eye on CRH. They've moved their main listing over to the US, but they've still got the London listing as well. It is the construction company that's seeing strong gains in North America, and that one up 2.7% today. But going the other way is Rightmove. We've reported earlier in the week the drop in house prices, and they are seeing fewer houses coming onto the market, and that is negative for the property portal. So Rightmove down 2.7, actually down 3.5% now, still extending those losses. Melia Hotels, though, a bit more positive news. They're seeing strong bookings for the Spanish hotel group into the summer, and that's getting a gain today, similar to what we heard out of IAG earlier around those booking numbers doing pretty well. We've got a deal over in the defence space. Leonardo is offloading its submarine business for around 400 million euros. This is to Fincantieri, which for them is negative because they're funding it for a massive capital raise, 400 million euros. So that one is declining. Leonardo getting a bit of a boost. And breaking news earlier on Vodafone, their deal to merge with Three UK, their UK businesses, has actually been approved on national security grounds by the UK government. It still faces a CMA probe on antitrust, but on security grounds it is approved, and it's boosting that one. We've brought up Sabadell. We're keeping an eye on that one. Got a takeover bid at 2.1 euros, of course, but they're out today saying that they don't like the way that BBVA has gone about this. They're complaining about some of the meetings and publications on that. That stock coming down 0.2% this morning. We'll take a look at chips, though. TSMC, a huge gain in sales, according to that report earlier today. But we did also have earlier in the week the warning from Infineon that sent that stock plunging, and perhaps that is a bit of an overhang for the sector. A pretty mixed performance for those. ASML up 0.8%, BE Semi as well. ST Micro lower very slightly. Just one morning call to bring you Zalando. This one is a buy over at Berenberg. Zalando reckons we're all back online buying clothes for the spring season, the spring party season. They said that earlier in the week, and Berenberg reckons you should buy into that trade. That one's getting a nice boost on that rating change. It's up 3.4% for Zalando in Germany.
Spring party season, is that a thing, Joe? I take your word for that. Don't know where my invitation is.
Yeah, I'm into it. I'm into it.
Thank you very much, Joe Easton from our equities team with all things clothing and beyond. Coming up on the programme, the US poised to impose tariffs on China EVs as soon as next week. More on that Bloomberg scoop. That's coming up next. And also on the EV theme, Bloomberg's Oliver Crook is at a racetrack in Berlin. Oliver, you're not just there for fun, of course. You have a big interview coming up.
That's right, Anna. We're at the Tempelhof Airport, the historic airport here in Germany. You can hear some of the noise because it's also the pit lanes now for the Formula E race that is going to take place over the weekend. Formula E, really a new sport, only about 10 years old, really trying to compete with Formula One. And here you can see everybody is getting prepared. And we're going to speak to the CEO a little bit later about really building this business, building a fan following for this sport, and really how to compete with the incumbents like Formula One. That'll be later. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
We could face bigger challenges.
Britain's next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think firms need to recognize two things being true at the same time. It is a large market with large potential. At the same time, there are certainly factors at play, many of which geopolitical, that should give companies a moment of pause.
That, of course, is the Citadel Securities CEO Peng Zhao talking to Bloomberg about the challenges investing in China right now, and we continue that conversation. Bloomberg sources understand now that President Biden's administration, we think this is going to happen next week, will unveil fresh tariffs on Chinese EVs and in other key strategic sectors as well. We think this is going to happen next week. Timing's a little bit kind of speculative at this point, but this is a near-term story that you're going to have to factor into your thinking. Joining us for more on this scoop is Bloomberg's Asia transport reporter, Danny Lee. Danny, just talk us through exactly what these tariffs are going to look like and how far they're going to go, and why are we talking about it now?
Yeah, this has been in the running for a while, a 2-year review by President Biden's administration, and particularly in an election year, someone like President Biden has to set out his stall in particularly where the rhetoric from someone like the Republican candidate Donald Trump, who's calling for across the board 60% tariffs on all Chinese imports. Now, this is President Biden setting out his stall on at least three key sectors, which clearly cause the most concern: on electric vehicles, on solar, and on batteries. And so therefore, we are expecting to see a significant tariffs put in place, but unlike Donald Trump, who wants to see across the board, this is more targeted, more measured, and it's very much focused clearly, when you talk about the election, in areas where the automakers in the US are under serious pressure from Chinese EV makers overall. And so therefore, when you look at where production is in the US, clearly in a lot of swing states. So it's a fascinating thing to see that could play out as soon as Tuesday.
Yes, the politics clearly hanging over this in an intense fashion then, Danny. How might China respond? I was looking at the Ministry of Finance briefing this morning to see if there was going to be any response on that front. Nothing too obvious, but maybe you spotted something.
Yeah, I think this is a key thing to see how China will respond. And we can just look back to how China reacted specifically to President Biden, his announcement a couple of weeks ago as well, that the US would put tariffs on Chinese steel and aluminum. And so whilst China was clearly very angry with that, we haven't seen a specific response yet. And until we see on Tuesday what the US is prepared to unveil, we just have to watch and wait. And clearly, Chinese EVs are not getting into the US anytime soon.
Danny, thanks very much. Bloomberg's Danny Lee in Hong Kong. Really fascinating story then, emanating out of the White House, Biden and what he plans to do next week with regards to tariffs on Chinese product. But there are all kinds of other China threads to pull together. And today we got this survey by the EU Chamber of Commerce in China saying only 13% of those businesses that are European doing business in China see China as a top destination for investment. And that's the lowest since 2010. So we've certainly fallen a long way.
So big German chemical companies have made massive investments in China over the last few years. The danger now is that maybe some of those assets end up looking stranded. The geopolitics makes them more difficult. Clearly, there's going to be huge demand for chemicals in China, but this kind of big footprint that German industry developed in China, I wonder whether or not there's maybe some kind of rethinking of that strategy, and this speaks to it. Do you just go elsewhere in Asia? Or is this a wholesale retrenchment from the region?
Yeah, and in some sectors we have seen that, haven't we? So not investing in China perhaps, but investing in Vietnam or Indonesia or places, other places in Asia. It's interesting that certain businesses in some sectors, and I haven't heard much in the last 24 hours from the chemical sector, but certain businesses we are seeing some pushback, or at least a search for clarity, if that's even possible, in an election year. We played some sound earlier from the Snap CEO asking for just some clarity on this.
Yeah, I think that is wishful thinking. I think this is a moving target. This is a geopolitical situation that is developing really quickly. The Ukraine war's made it more complicated. What's happening in Gaza is making it more complicated. What's happening in the South China Sea is making it more complicated, and the election is making it more complicated. Clarity is not something that I think is going to be we're not going to be seeing a great deal of.
Okay, we will keep an eye on that story, of course, for you. Coming up on the programme, we take a look at the UK's better than expected GDP figures and the impact on rate cut bets. We'll talk about that. The transatlantic flows in focus as well. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Friday the 10th of May, little recap. We are 30 minutes into trading here in Europe. Let me tell you what is happening. Bonds are bid. We've seen stronger GDP data out of the UK today, but let's turn our attention to what is happening with the equity market, which has had a really strong week. European equities continue to climb higher. They gapped higher first thing this morning. And we're not talking about big gains here, but they are incremental gains over the course of the week. Let's flip my screen here a little bit. Basic resources are driving it this morning. Utilities are up. Energy's up. That's not exactly a growth-orientated mix, but nevertheless, we are seeing positive numbers being posted. In terms of what we're seeing on the week, let me just give you a 5-day number, just so you know kind of what you've been seeing throughout the course of the week. It's always nice to keep track. So a gap higher this morning. The Stock 600 is now up by nearly 3% on the week, 2.8% so far this week. That's a decent gain, and it's not a bad gap higher this morning either.
Okay, and I was just going to look at the sectors over 5 days as well, because that can be useful. Again, though, to your point about today's session, with utilities not doing too bad, that's the best performing sector over the past 5 days in Europe, across Europe. It's the utilities story, which doesn't tell you a great, risk appetite story.
Doesn't scream growth, does it?
It doesn't, no. But construction and materials not far behind, and industrials and technology and energy. And actually, to your point, most sectors, nearly every sector in positive territory, apart from
the cars.
Yes, autos and auto parts.
Cars have had a really bad week. All of the numbers.
Cars and their shoes, BMW. As they will now be known.
Car shoes. You want to buy the car? You want to buy the right shoes for the right weather?
Apparently so.
Yeah, I try to explain this to various people. Nobody ever really listens to me. Should we talk about the UK GDP data as well? Because you're certainly seeing a little bit of reaction there in the gilt market.
Yeah, absolutely. So the bond market's digesting a better than expected print on GDP. Britain has bounced back from a shallow recession with stronger than expected GDP numbers for the first quarter and for the month of March. The data provides some relief for the Prime Minister, Rishi Sunak, perhaps, but may temper the market's enthusiasm for a June rate cut. So there's a lot to put together here. Let's bring in to the conversation Sam Unstead from the Markets Today live blog and Anna Andrade from Bloomberg Economics. Anna, if I could start with you on the impact of this data. It's interesting, I suppose, as a narrative for the Bank of England when it goes out there and tries to explain to the country what's happening here. We're getting closer to rate cuts, and yet we're seeing this data bouncing back, and we're coming out of recession. Is there a mismatch in timing there? How will that fit for you?
Yeah, I think on the surface it might seem like a mismatch, and if you look at the headline number, it was quite a strong GDP outturn. We in the Bank of England and consensus were expecting growth of 0.4. It came in at 0.6. That's a big surprise. But actually, the question now is whether the growth will remain at this pace and this sort of high growth trajectory will be maintained. Our view is that it won't, and we're a bit skeptical, and today's data doesn't really change this view, because when you start looking at the breakdown of the GDP data, you actually see that a lot of it was driven by net trade. And within net trade, it was a fall in imports that sort of added to growth. And when you look at domestic demand, that has only grew by 0.2%. So it hasn't even recovered to the pre-recession level, let's say. So in a way, when you look at the components of the economy that are being affected by interest rates, that's still pretty subdued. So in our view, we just don't think that, this is going to translate into higher momentum.
So it isn't as strong as it might at first appear then, this GDP print. And tell us about those sectors that are struggling right now, still coping with the higher interest rate environment, even as we talk about lower rates. That hasn't happened yet.
Yeah, no, definitely. I think the fact we are expecting rate cuts this year, we think the first rate cut from the BOE will come in June, and that will provide some relief, and there will be sort of growth drivers this year. We had the easing of financial conditions, we have the fall in energy prices, some income taxes, and that's all going to add to growth. But I think the main thing to consider still is that monetary policy will still be restrictive. So any sort of pickup on the growth that you're going to expect will be limited.
Sam, why have the markets in so many ways have been muted in their reaction to all of this? You've got a Bank of England that is sounding quite dovish, yet the market's barely budged. The bank's trying to distance itself from the Fed, but the Fed US data is having a really big impact in terms of how we are positioned here in the UK. Is that something that when you talk to people, they're expecting to change, or is this basically something we're just going to have to, and the bank is going to have to live with?
Yeah, I think this is something that the bank's going to have to do. I mean, actually, it's interesting. So I agree with Anna. I think the markets agree with Anna as well. Yeah. Almost nothing moved today on the data. So yes, the headline looked a little bit stronger. That could, if you're just looking at that, might raise some questions about strength of the economy and that leading into the Bank of England. But I don't think it does really. I think at the moment, the wage data we're going to get next week, and then the inflation data we're going to get the week after that. That's where we'll really get to understand the Bank of England's thinking.
Is the Bank of England overly focused? There was a question, I think, in the press conference about this yesterday. Is the Bank of England overly focused on the inflation data because the labour market data is so rubbish?
Yes, I think you could probably say that. Yeah. So with the labour market data in particular, so when we're talking about being data dependent, and the Bank of England is talking about being data dependent, you're not just talking now about those official figures, because not till September you're going to get the labour force survey through, guarantee that it's going to be perfect then. So you're looking at everything else. And actually yesterday, for example, we had the REC data, the REC KPMG data, and that showed again the same sort of trends. Permanent jobs going down. The market is sort of loosening, but wage growth still remains quite strong. So I think for the inflation data too, the really, really important part, again, is going to be services inflation. If that remains really sticky, then that could start to change the picture a little bit. But really, I think June looks like it's very much now on the table, and it would take quite a big surprise now to prevent that being the case.
It's really interesting, isn't it, looking at the wages story? I mean, even the Bank of England is expecting that wages, we're going to get real wage gains this year, because inflation's at 3% or so, and wages they're forecasting will run at 5.25% this year. So that's quite a chunk above inflation, and you wonder how much that changes that recovery trajectory. Interesting that it hasn't been, as Anna said, the positivity hasn't been driven by the domestic economy yet, but maybe we get a bit more of that, and I wonder how that changes or threatens to change the politics, perhaps.
Yeah, it may do. I mean, I think, so the wage growth figures, so like this guy sort of alluded to, the official jobs data isn't enormously useful right now, but the private jobs data is, and I think, again, that REC report yesterday, it shows, permanent hiring is slowing, but the wage growth is still going up because of this structural mismatch between skills. That is not going to go away anytime soon, so that's going to have to remain part of the thinking. But again, I think what you're going to need to see is a pretty significant upside surprise now on either wages or inflation or service inflation to really, really change the conversation.
Anna, how far out can we look with the UK economy? How much visibility do we have in terms of our understanding what we're going to look like in a year's time? How long will this cycle last? When we finish this cycle, how long does the kind of the floor last for? How long before we start hiking again?
Yeah, I think what's determining a lot of the business cycle right now is interest rates. So we had this big shock in interest rates that's weighing on the economy, and any sort of growth or recovery that we're going to get, cyclical upswing that we're going to get in the next few years, will be just sort of on the back of a reduction of rates. Yeah. And then the big question is like, okay, what's the supply growth of the economy? Where are we going to settle? And then I think it's also not very optimistic. I mean, we know that the UK has sort of problems with investment, with productivity, productivity, and now with a limited labor supply. So overall, we think
we're geared for a pop back in inflation, basically. If the productivity story doesn't improve, growth picks up.
Yeah, I think things are not looking. It's not a major risk to inflation because supply growth is still going to be sort of very low. Yeah.
Anna, tell us update us on the linkages between the UK economy and Europe and the US, and where the emphasis should be, because obviously the Bank of England tries to push back on the idea that we're connected, more to the US than Europe, and we've seen some of that translation from the treasury market into the gilt market. They didn't want to see that necessarily. So we see some pushback there. But then, this is a totally different sector, but you look at the IAG numbers this morning, it's all about transatlantic demand. It's all about, one assumes, linkages between one big financial services market and another. And if M&A starts to come back, I just wonder, where is the external factor to watch, I suppose? Is it the US or is it Europe?
I would say it's probably mostly Europe. I think in terms of growth, the story in the UK, it's much similar to Europe than to the US. So we've had a recession. We've been sort of in a state of stagnation for the past 2 years. Monetary policy is clearly having an impact, and that sort of has been the story in the euro area. When you look at the inflation dynamics, that's where you kind of pause a bit and you think, actually, services inflation and wage growth is very high, is much higher than in Europe, so maybe we're more similar to the US. But actually, we actually think that the inflation dynamics are also changing and are also becoming much more similar to Europe, because we're going to get this fall in energy prices. Europe is also experiencing this inflation in energy. And when talking about these persistent components that you mentioned, services and wage, they are high, but the expectation is that they will fall once headline inflation falls, because if you have headline inflation sort of hitting 2%, then inflation expectations adjust, and so people don't go out and ask for higher wage growth, and then services inflation also moderates. So it's sort of like a chain of events that will happen, and I think what the BOE sort of needs to see first is headline inflation getting to 2%. And in that sense, we're just much more similar to Europe, to the US. We're much closer.
In terms of services inflation, this makes my mind go to another Bloomberg story this morning.
Anna's been talking about this all morning. She's been waiting to talk about it. It is making her blood boil.
No, I thought of something measured and sensible to say.
Why?
Well, it's all about tipping, basically. Some of our colleagues have written a great story about how there's increasing emphasis on tipping in the UK, but is specifically in pubs. And so this is when you go to the bar and you order drinks and do you tip. And I don't know what your experience is, Sam, but it feels as if the dynamic here, the social pressure has changed here a little bit.
No, I think the technology has changed.
Well, exactly. So this was the sensible thing I was going to say about how tech intermediation has changed the culture. It has. Because you'd never get a bartender give you your drink, say that's, £5-6, and would you like to tip me? They never would say that, would they? But they'll pass you a machine.
Anna, when did you last go to a pub when they said
question.
£5 or £6? Was that's 1 pint? That's less than 1 pint.
Well, yeah, there we go. I was reaching. But the point was, they wouldn't ask you for a tip, would they? But the machine will.
The machine, because it's easier, because you're just tapping on it. It has the little program that comes up, but this comes back to the wage story, because I have to say, I have friends of mine that run pubs talk about how difficult it is to attract wages at the moment. The legislation is going to change so the staff get all of the tips soon, and this is a way of the big pub chains in particular basically dealing with their wage bill.
Yes,
and because they're struggling to attract people and they're struggling to pay people, and the margins are so small now. Taxes have gone up, etc. So I think this is basically part of the wage story rather than a technology story.
I'm sure there is a sensible wages story in here, Anna.
Sure.
I'm not sure what it is, but there is one.
Do you know what tipping stands for?
No, enlighten us.
To ensure promptness. So that's what it goes back to.
Right. I had no idea it was an acronym.
So it's TIP rather than tip.
And where did it originate?
I think it was back in the 1600s or something. Basically, so you were giving money to precisely in Europe. You were giving money to the barman to ensure that he gave you your pint quickly.
Okay, I did not think it had been involved here, but that's new information for me. Thank you very much for taking us there,
That's me trying to be sensible as well.
Excellent. Right, we will move things on shortly. Thank you very much to Sam Onstead from the Markets Live blog. And from Markets Today blog, to get that correct.
You want to get that name right.
Yes, and also to...
the name of the show.
And also to Bloomberg Economics' Anna Andrade. Thank you for joining us. Coming up, we will be heading back to Berlin. We saw him earlier, Oliver Crook enjoying himself far too much in the pit lane. Bloomberg's Ollie Crook is on the ground for us. He's having a nice time on the racetrack. He also has a great interview lined up for us, though. The CEO of Formula E will be speaking to Ollie shortly. This is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asins is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Friday the 10th, we're 46 minutes into the trading day here in Europe. Stocks are generally bid. As you can see across the piece, we are looking at some fairly decent numbers coming through, and this builds on what has been a fairly decent week as well. Bonds actually have been fairly well bid too, and it's interesting to see the reaction this morning to the data that we are seeing out of the UK. But it is the weekend, so we should talk about sport. Obviously, many people are focusing on what's happening at the Champions League as we start to see the finalists being confirmed, and we'll continue to watch, obviously, what's happening with the football. But the racetrack is also of interest this weekend. Formula E is now in its 10th season, and as the sport grows in popularity, questions are being asked about the championship's carbon footprint and net zero targets. Let's find out more. Ollie Crook is at the Formula E circuit in Berlin and joins us now.
That's right, Guy. We are here at the Formula E circuit where we're looking at Tempelhof Airport, really steeped in German history, but really containing today the future potentially of automotive racing in Formula E. I mean, you can see the cars behind me just getting lined up there. And these cars, there's such a rate of change in terms of the technology going into these things. You know, acceleration from 0 to 60 in 1.82 seconds, faster than Formula One on that point. But where does this go as a business? How do you build a fan base? Well, we've got the right person to ask that question to. It's Jeff Dodds, the CEO of Formula E, who joins us now here at the race circuit.
Good morning. Welcome to Berlin.
Yeah, thanks so much. So listen, where are we right now on the journey for Formula E? We're 10 years in. You're 1 year into your tenure. Where do we stand?
So that's right. So Formula E started just 10 years ago. So we're effectively babies in the world of motorsport. Yeah. If you compare that to something like Formula One around 75 years old. So we're at the start of our journey. But of course, we have this wonderful tailwind of electrification. When Formula E was started just 10 years ago, I think that year there were 300,000 electric vehicles sold across the globe. If you compare that to now this year, the estimate is around 18 million electric vehicles will be sold this year. So whilst it feels like we're still at the very early point of our journey, around 20% of all cars in the world sold are electric at the moment. We still have that kind of 80% ceiling we're pushing for.
Right, and part of that journey is going to be for you defining yourself not as just an alternative to Formula One. So how do you make it not the sort of beyond meat of Formula One? How are you positioning for that?
Yeah, so obviously everybody speaks to me. They speak to me about the comparisons with Formula One, which is perfectly logical because we're a world championship. We're single-seater racing cars, and we're racing on tracks. But when Formula E was founded, it had three principles. One of those was to be an elite world championship racing series, so it was all about racing. And we would argue quite strongly we have the most competitive racing series in the world right now. But the two other ambitions were, one, the tech transfer, to develop latest electric vehicle technology, so to be at the cutting edge of EV technology. And you see here racing today our manufacturer partners. So you see Porsche, Jaguar, Nissan, Mahindra, Stellantis, Immerse, ERT, you see manufacturers, and they're developing tech on the racetrack that will make its way into their road cars. And the third thing we founded for was sustainability. So we wanted to be a platform that could educate the world around climate change and the role that electric vehicles can play in decarbonising road transport. So three things.
And so, I mean, the rate of change has been absolutely breathtaking in the sport. I mean, you've doubled the horsepower in 10 years. The new car you're putting out at the end of the season is going to go, accelerate 30% faster. I mean, these are really breathtaking sort of changes in technology. What more is coming? What does the sport look like in a couple of years?
So the really simple answer to that is when you look at the car development, longer, faster. They're the two things people want to see. So today the racing in Formula E is about 40 to 50 minutes long, which actually is really interesting because it's really good for family viewing. So we're attracting a different audience to traditional motorsport, like Formula One, where the race is about an hour and a half long. But we want to have the ability to race for longer in the future, and that means batteries with bigger capacity. And the second thing is faster. I mean, this is a motorsport. Everyone wants it to go faster. So you're right. We announced the car that will be on the track for next year will be 30% faster than the current Formula One car, 0 to 60 in 1.82 seconds. But also people like a bit of top-end speed as well. So these cars you see behind you here will go about 200 miles an hour at the top end. Over time, I would expect to see that go to 220, 230, 240. So the cars are getting faster, the batteries are getting bigger.
So here's the question. Will it ever be faster than a Formula One car?
Well, it's already faster than the Formula One car.
In acceleration.
If we wanted to. And I think one of the interesting, obviously for Bloomberg viewers who are very interested in business, one of the key things is the economic return on investment. So if you think about Formula E, the cost cap in Formula E, so the amount these teams can spend every year is around 13 million euros. That's all they can spend. If you compare that to Formula One, where the cost cap is about $140 million, so they have around 10% of the budget to play with. So of course, if I gave them a budget of 140 million euros, they could develop cars that would go much faster than Formula One cars with electric technology. But the reality is we view ourselves as an inclusive motorsport, not an exclusive one. This is not about the richest organisations in the world taking part. We want everyone to benefit.
Presumably you want to grow your sponsorship, you want to grow that base, you want to get more money in because it will bring more fans and it'll be a virtuous cycle.
At the right pace. We need to support our manufacturers here because a lot of them are using the racetrack as a laboratory to develop new technology. So it's about manufacturers and teams, it's about growing a fan base, and that's growing very quickly, as you mentioned up front, and then it's about growing the total value of the organisation. But
where would you like that to be? Where would you like to see the total value in the next few years?
Well, so we don't talk about our value today publicly. We have two very large investors in Liberty Global, Warner Brothers Discovery. But as I say, this is a business that's only 10 years old. So they're investing for what they believe the future of this business could be. I think fan base, though, is a good proxy. So when I started about a year ago, the fan base in Formula E was about 290 million fans globally. As of now, the latest time we did the big survey, it was up to nearly 400 million fans. So around 30% growth in a year. This is a business that's growing exceptionally quickly.
And in terms of the other thing that you need to do is also attracting other OEMs, other manufacturers to the sport, right? There was Mercedes, BMW, they stepped back. What I'm surprised by is that there are not more Chinese automakers fully who have really dominated the EV race. Are you in conversations with them?
Oh, yeah, of course. So you have the big Chinese automotive groups. So BYD now becoming prevalent across the world. In fact, I think the biggest EV manufacturer now in the world. You've got Geely Group.
Could you see a BYD team in the next couple of years?
I could absolutely see a BYD team. I could see a Geely Group team like Lotus or Zeekr, SAIC, who obviously own brands like MG across the... So absolutely I can see a Chinese team. We actually have two Chinese teams here. We have ERT, but we also have Envision.
What about a Tesla team?
I think Tesla's unlikely, and I'll tell you why I think it's unlikely. So all of the teams here are racing on a common battery. So I'm not sure that Tesla would be so keen to run on a battery that isn't their own. The second thing for Tesla, I would say, is they are the dominant force in the electric vehicle manufacturer. They were the people that started it all pretty much with the Roadster. I'm not sure, they don't need the exposure, so they don't need the PR around it. And the final thing I would say is a lot of the teams here have been racing in Formula E for a long time. Tesla would not be competitive from day one, and I'm not sure how that would fit with
that. Sounds like a challenge to Elon Musk, which is always a dangerous thing to do.
It's never dangerous. I would love Elon to call me. I'm just not sure it will be top of their list.
And in terms of your fan base, and obviously growing a sport almost from scratch, where are you seeing the biggest pickup? Where are your biggest fans? Where are you the most successful right now?
So Southeast Asia, across China, we have over 100 million fans in China alone, so growing incredibly. To your point about the Chinese EV market growing. But our fan base is very different to motorsport traditionally. So if you think about our fan base, roughly split 50-50 male-female, that's incredibly different to motorsport. Roughly half of our fans are under the age of 40, and they all have an interest in climate change, sustainability, innovation and technology. So it's quite a different audience. So whilst it's growing quickly, it's growing outside of a traditional motorsport base.
Jeff Dodds, thank you so much. The
Absolute
CEO
pleasure.
of Formula E joining us here at Tempelhof-Rafeld Airport, the racetrack that's happening, the race happening this weekend, Saturday and Sunday, starting at 3 p.m. tomorrow. And as you can see, all the cars getting prepped and ready for the race tomorrow.
Oliver, thank you very much. Really interesting conversation. Bloomberg's Oliver Crook in Berlin talking Formula E. What else is on the agenda today? That's for your weekend, of course. But today, before we get to the weekend, we get 11 a.m. UK time. We'll get an AGM from Standard Chartered. 12:30 London time. The ECB publishes the account of its April policy meeting. How certain is June? What does the data look like in the run-up to June? At 3 p.m. UK time, University of Michigan consumer sentiment out of the States. And we're looking at a whole host of potential sovereign rating changes. We'll keep an eye on those. And finally, central bank speakers. There's plenty of them, Guy. We hear from a lot of Fed voices and a couple at the BOE as well.
Yep.
Swati Dhingra, Hugh Pill. Both of those will be out speaking a little later on today.
Yeah, and you can expect some more volatility around some of those comments that we get from those central bankers. And in some ways, that's part of the problem, trying to kind of see through the noise of all these central bank speakers.
And there's also an IPO you're watching. Zika.
Back to the electric car story.
Yes.
So Chinese company, high-end Chinese company, potentially listing in the United States a little bit later on at a much reduced valuation, which speaks maybe to this idea that, A, the challenge at the moment within the electric car industry is enormous in terms of the price discounting we're seeing, but also the geopolitics that we're going to hear more of next week, potentially Tuesday, Wednesday from the Biden administration around restrictions of Chinese cars coming into the United States, the second kind of leg to that stool.
Something else that is on our radar very much for next week is the Qatar Economic Forum. This is
how many hours is it to go?
Powered by Bloomberg, and it's taking place in 3 days, 22 hours, 4 minutes and 12 seconds. Just to be precise, in case you need that level of precision from us, it's available on our website. There you are, a countdown clock to the Qatar Economic Forum. But in all seriousness, energy transition and the geopolitics, 2 of the 5 sort of editorial pillars of the 2024 event, another one being sport. You can't go to that region without thinking about the business of sport, it seems.
Next week's going to be dominated by the CPI data out of the United States. That's the kind of the pivotal story, the story that we're all waiting for. There's a big conference taking place also in Paris, just outside Paris at Versailles on Monday as well. This kind of Invest in France forum. I suspect we're going to hear a lot of voices coming through from that as well. We'll see exactly what that delivers from some of the big bankers that are going to be attending that event. But next week, it is CPI week.
3.4%. Is that what you're looking for? That could be the number to introduce the week. That's the CPI year on year, if you just want the sort of vanilla one. Obviously, many other measures of core and super core inflation are available on the Bloomberg terminal. That is it for markets today. The pulse is up next. European stocks moving higher, Guy.
They are. It's been a very strong week, and it looks like we're continuing that this Friday morning. Does it continue into the close? We'll find out a little bit later. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. President Biden is set to unveil sweeping tariffs targeting Chinese EVs and strategic sectors with an announcement possibly as early as next week. We'll bring you that Bloomberg scoop. Britain bounces back from a shallow recession with the strongest growth in 2.5 years. Meanwhile, the BOE leaves the door open to a June cut. My interview with the governor, Andrew Bailey, coming up. Plus, the Prime Minister, Benjamin Netanyahu, says Israel will fight on in Gaza with or without U.S. support as Washington threatens to withhold more bombs if Rafah is invaded. So we have a lot to get through, a lot of geopolitical, of course, tensions across the board. If you look at European markets map, they're kind of edging sideways. Now, a lot of the focus will actually be from the U.S. Here in the U.K., we did have better than expected GDP data, or certainly the U.K. economy bounced back from a very shallow recession. And, of course, pound edging higher on the back of what we heard from Governor Bailey. So you can see sterling 125.27. A couple of other things we're watching out for is really treasuries. So I would keep this at the forefront of your mind throughout the day. We have many Fed speakers ahead of that really important CPI number next week. We hear from Michelle Bowman and Neil Kashkari. Again, any clues about the timing of policy easing is something that a lot of these markets will want to know. And then the focus in general is what the Fed does in the coming weeks and the coming months. CPI next week. We have a number of events that we want to cover really well next week, but of course CPI left, right, and center. Now on to a Bloomberg scoop, and Bloomberg has learned that the Biden administration is set to impose tariffs on China EVs and other strategic sectors as soon as next week. Well, the move follows a review of tariffs first put into place by the Trump administration. So let's get more now with our Craig Trudell, our Bloomberg Global Autos editor. We thought, Craig, waking up to the news that actually there were EVs and tariffs, that you were the perfect person to first of all try and understand the difference between what the U.S. is doing and Europe is doing. But actually the Biden administration is going pretty strong on this.
Yeah, I think this is a case of the U.S. being a little bit out front in terms of targeting Chinese EVs, and the European Union playing a bit of catch-up in October of last year, opening an anti-subsidy investigation, which, by the way, will in all likelihood result in some additional tariffs to be introduced as soon as or by July, at least on a provisional basis. So I think this is the case that we're seeing a general sort of move globally at this point of concern in the sense that, China has become last year the largest car exporter, and EVs being a big part of that and being the sort of future of the industry and something that the rest of the world is concerned about, that becoming, a trend with real staying power.
But Craig, so what does this mean for the China EV makers? Because actually there are many, many of them, right? We were going through the list, I think, when we saw each other a couple of weeks ago. I mean, there are many of them, and they're really subsidized by the government.
Yeah, I think the EU investigation and the sort of impending subsidies that I think everyone is largely anticipating will come through. It's a matter of, how much more tariffs as opposed to whether there will be additional tariffs. I think that's a much bigger deal for the Chinese companies because they're really looking at the European market as one that they can crack. I think these moves by Biden may actually not amount to a whole lot, in the sense that I think the Chinese companies have really sort of viewed the U.S. as not open to them, that they are not, even entertaining the possibility of going into that market. Even a company like BYD that has been really on a roll has viewed the U.S. as not an attractive market worth even trying to crack.
Craig, at the same time, so Elon Musk says Tesla will spend more than $500 million on the supercharger network. So, I mean, is it surprising?
This is something else, because he put this on X as a, referring to it as a reiteration. This is not a figure that I've seen or heard out of Tesla, and it really smacks of, in early 2019, there was this Musk move to close a bunch of Tesla stores, at least to try to. I think he did that very impulsively, realized that he couldn't actually close stores. His company was locked into leases. He had to kind of do a U-turn. This really feels like a similar sort of situation of damage control, of realizing that cutting almost his entire supercharger team did not go over very well with his customers and just of lately his clients, in the sense that he's partnered with a bunch of other car makers to offer his superchargers. So this feels like a bit of activating damage control mode, if you will.
Even regret? Or is that maybe going too far?
I do think that he wanted to make make a serious message, send a message to the troops of, when I say I want to cut costs and be, in his word, hardcore, I mean it. And this really sent that signal in a way that was quite effective internally, even if it did some damage that he's now having to clean up after.
Craig, thank you so much, as always, for joining us. That was Craig Trudell, Bloomberg's Global Autos editor. Now joining us to talk about the markets, to talk about central bank action, Monica Defend, head of the Amundi Institute. Monica, as always, thank you so much for joining us. I mean, it's been quite a week. There were a lot of earnings, and now the pivot is really going to what Fed speakers and what kind of monetary policy we'll be left with in the U.S. What do you think will drive markets going forward?
It will be the central banks, as you were mentioning. We had today the GDP data on UK, so everyone is asking what the Bank of England will be doing. On that front, we believe that the ECB will start cutting in June, and later on we will have the Fed. So we will have the Fed delinking from the ECB, with all the consequences that this might imply on inflation and on the FX. The central banks, it is not in their mandate, but the FX consequences have to be seriously monitored.
Monica, I mean, I think you're still expecting actually a Fed pivot in the second half. We could have, that being supported by data, but the data has been all over the place. Or certainly, the Fed promised something in December that they didn't go through it. Why has it been so messy? Is it communication, or just a much stronger than expected economy?
I think it's the second one. So the U.S. economy proved much more resilient than anyone was thinking. Now what we see is real rates getting around 2%. So we do expect that eventually financing condition will tighten, and this will start eroding the consumption side. So this is where this slowdown will come from. Let's see next week's CPI data and the retail sales to have a more complete view, but we believe the Fed will start cutting it in July.
So, Monica, as there is more and more policy divergence, I'm thinking of Bank of Japan, but even maybe between the ECB and, of course, what we're seeing with the possible Fed, how do you play that in the markets?
Well, on the duration front, we remain quite flexible with a preference for the UK, in particular, the short end. We have positive bias towards the Treasury, and when it goes to the euro area, we are looking at the peripherals, in particular the BTP, while we are neutral on the euro duration.
Is there anything, Monica, that the markets are not really, constructive on right now where they should be? I don't know whether it's even concern on geopolitics, but it seems like quite a volatile market, but we also had a good earnings season.
Yes, definitely. What surprises me, as always, is this agnostic view and positioning on the geopolitical front. As long as on commodity prices, oil prices stay confined in a controlled range, the market seems to ignore what is happening on the geopolitical front. And if you look also at the election calendar, which is quite rich, I would say, for the second half, still the market is not taking any position. But as you were mentioning, earnings will prove to be pivotal. With this level of the market, valuations are quite expensive. Therefore, it is necessary that earnings do not disappoint.
So, Monica, what's your preference when you look at U.S. equities? Do you go for sectors? Do you stay away from the big seven?
Yes, it is very difficult amid this macro uncertainty and this level of valuation to have bold top-down stories. So we really prefer to position within sectors in the UK market. In Europe, we are balancing quality and defensive. And on the US market, it is more on the equally weighted versus the market-weighted index. But again, it's more a bottom-up, let's say, this way market than a top-down play.
Monica, thanks so much. Monica Defend, of course, head of the Amundi Institute, stays with us, and we'll talk a little bit more about Bank of England and maybe some of the opportunities or not here in the UK. Now, coming up, some relief for the British Prime Minister, Rishi Sunak, as the UK economy bounces back from recession with stronger than expected growth. We'll talk about that next, and this is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Now, the UK has bounced back strongly from a shallow recession. GDP jumped to 0.6% in the first quarter compared to the previous 3 months, higher than forecast and the best reading since late 2021. Now, let's discuss all of this and what it means for the BOE, firing the starting gun on an easing cycle with Anna Andrade from Bloomberg Economics. So, Anna, let's start with the GDP data. Better than expected after a pretty shallow recession, but it's far from spectacular.
Yeah, I think the question now, I mean, it was 0.6%. We were expecting 0.4%, so it was a big surprise. And I think the question that everyone's asking is, like, is this the start of, like, a speedy recovery? And is growth going to be maintained at this current pace? And we don't think so. We're a bit skeptical. So we actually think that because monetary policy is still in restrictive territory, that's going to put a lid on growth. So the recovery will be broadly subdued. And what we saw in today's GDP data doesn't really change that view, mostly because when you look at the breakdown, you can actually see that a lot of the strength that we've seen in GDP was driven by net trade and by a fall in imports. And when you do look at the domestic demand, which is the bit that's most impacted by monetary policy, then it only grew by 0.2%. And it's still below its pre-recession levels. So in a way right now, it does add the risks to the possibility that, it will be a speedier recovery than we're thinking, but we don't have enough to sort of change our view that, it will be far from spectacular.
I mean, and it was really interesting. So we basically had the Bank of England yesterday, and he talked about market expectations, the governor, and it's clear that he thinks that the market has kind of been mispricing their willingness to cut, maybe because of what happened with the Fed, because they overpromised in December and then couldn't deliver through. The question is, once they start cutting, do they continue cutting? And Bloomberg Economics is quite bold with your prediction.
Yeah, we have like a cut at each meeting, and I think the way to think about it is that yesterday the BOE sort of signaled that it was uncomfortable with just 2 rate cuts. So we think that, they probably think that 75, maybe 100 is sort of a little bit more appropriate. And that's even considering the fact that they have a pickup in inflation. So inflation will go down to 2% on energy, on the fall in energy prices. But then the BOE expects it to reaccelerate to 2.5% later in this year, going into 2025. Still in that scenario, they still think that 2 rate cuts are not enough. And so where we differ from the BOE is that we actually think that headline inflation will fall to 2%, but will remain there for most of the year. Sort of, it will pick up a bit, but it will remain broadly stable at 2%. And then we think the BOE will actually be surprised on the downside by the inflation. And that's when it will sort of get more evidence that actually it can go at every meeting. But a lot of it will depend on the inflation dynamics. Those are central to the, to the speed. Yeah.
So interesting, Anna. Thank you so much. And Andrade there from Bloomberg Economics. Now, later in the show, we'll also bring you the interview with the BOE Governor Andrew Bailey following yesterday's rate decision. Still with us, Monica Defend, head of the Amundi Institute at, of course, Amundi. Monica, I mean, Anna was explaining there the view of Bloomberg Economics that actually once they start cutting, could be in June, they continue cutting. A lot of commentators saying that's dangerous because they probably didn't increase rates fast enough, and there's a danger now they're decreasing them too fast. What's your take?
We think that the Bank of England will start cutting as soon as June. More importantly, the market is really thinking that they won't do that much. We think they will do more. So whether it's 4 cuts, still we are above of market expectations, and this mismatch allow us to be constructive on the curve, in particular on the short end. When it goes to the readings that we do on the economic front, still on the manufacturing side, we'll see some weakness that is less evident on services. And when it goes to inflation, the direction is to 2%, but we are not sure that we'll get there. It will be something like a 2.3% on a 2 years horizon. So we're pricing in more cuts than the markets, and this is allowing us to be constructive on the fixed income in the UK short end of the curve.
Well, Monica, why do you think, I mean, the market seems to be mispricing. And again, a lot of people, as you're mentioning, a lot of people think this is a communication problem from the Bank of England, or is it external factors in trying to read the data?
Honestly, the market in general, in reading all policy, monetary policy, is extremely volatile. I think what has happened on the Fed down to the ECB. So by no surprise, probably it might be related to the Bank of England rhetoric. I don't know. The truth is that we are struggling in reading the correct patterns and pathways on the macro prints. And the reason being that after the pandemic, there are some regime shifts in place that are really challenging our traditional approach to macroeconomics.
Monica, as always, thank you so much for joining us. Monica Defend, head of the Amundi Institute at Amundi. Now, we continue talking a little bit about some of the corporate news out there, and Sabadell has accused banking rival BBVA of breaching Spanish laws with its hostile takeover bid as tensions mount between the two lenders. Now, BBVA is seeking to buy Sabadell in an all-share offer that values a smaller rival at about 11.5 billion euros. Now, the Spanish government has said it will oppose the deal or the bid. Sabadell's board rejected the offer, saying it significantly undervalues the business. Coming up, the Israeli Prime Minister Benjamin Netanyahu strikes a defiant tone against President Biden in his first public comments since the U.S. confirmed it was withholding bombs from its ally. More on that next. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Now, the Israeli Prime Minister Benjamin Netanyahu has struck a defiant tone against President Biden in his first public comments since the U.S. confirmed it was withholding a shipment of bombs to Israel. Now, speaking to American talk show host Dr. Phil, Netanyahu says he hopes the two leaders can overcome their differences.
I've known Joe Biden for many years, so 40 years and more. We often had our agreements, but we've had our disagreements. We've been able to overcome them. I hope we can overcome them now, but we will do what we have to do to protect our country.
Let's now bring in Bloomberg Opinion's Mark Champion. So, Mark, thank you for joining us. The international cost, of course, to Israel of sending the IDF into Rafah is clearly rising, right, with condemnation from many, many leaders. What is their argument for continuing this offensive?
Yeah, it's interesting because they're being told by the U.S. and others that you're going to have whatever military gain you have here, it's going to be a strategic loss. The Israeli response is basically, everybody wants us to have some sort of day after plan in which there'll be an alternative authority and so on, and that can't happen. Nobody is going to send any troops into, peacekeeping troops or whatever, into into Gaza, so long as there are 4 battalions of fully formed Hamas troops still there with their commanders and everything else. That will be the nucleus for a reformed Hamas, so that they can pose a threat to Israel again. So their view is that they have to do this militarily, and that no matter what anybody says, they just have to sort of bite down and do it, and then deal with the consequences and move on after that.
But, Mark, the U.S. position has basically been that the Israelis should not go into Rafah until they've moved civilians out of harm's way. So where are we on that?
Yes, I mean, this has been, the problem almost from day one of the war. If you recall, at the very beginning, before the land operation, President Biden, warned Israel, don't make the mistakes that we made in Afghanistan and so on. And so this has been a running sore where the U.S. would say, move civilians and do what you have to do. What we've arrived at in Rafah is the U.S. saying, was saying, move civilians before you do anything. Now they simply don't trust the Israelis to do what they're supposed to do. The Israelis have, for the first time really, made secure areas, bought tens of thousands of tents, put them there, and people are moving. The UN said that in the last day or so, about 80,000 people have moved out of the evacuation area that Israel assigned, sort of east of Rafah. But in fact, according to some satellite reports by Sky News, they estimate that rather more have moved. And it's not just from the evacuation area. In other parts of Rafah, people are moving already because they know what's coming.
Mark, thank you so much for the update. Of course, this is a story that we'll continue following very, very closely. That's Bloomberg Opinion's Mark Champion. Now, coming up, we talk China. Xi Jinping also leaving Europe later today with the firm backing of Hungary in their fight against the West's accusation of overcapacity. Details next, and this is Bloomberg.
Seeing firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg.
Now, President Biden is set to unveil sweeping tariffs targeting Chinese EVs and strategic sectors with an announcement possibly as early as next week. Britain bounces back from a shallow recession with the strongest growth in 2.5 years. Meanwhile, the BOE leaves the door open to a June cut. Plus, the Prime Minister Benjamin Netanyahu says Israel will fight on in Gaza with or without U.S. support as Washington threatens to withhold more bombs if Rafah is invaded. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So the Chinese President Xi Jinping has pledged more rail and energy investments in Hungary following his visit to Europe. Now, Beijing is counting on the Prime Minister Viktor Orban to push back against overcapacity accusation by other EU nations. Well, let's get the latest from Bloomberg's Piotr Skolimowski. Piotr, thank you for being on. Now, President Xi will wrap up his visit in Hungary today. How did it go and what did he actually achieve?
Well, obviously, it's this visit has been quite. It's stood in quite a contrast to the visit in France previously earlier this week, and what President Xi Jinping pledges rail and energy investment in Hungary. We're talking about investment to the tune of almost 10 billion euros, although that comes with all sorts of strings attached and loans, so it's hard to say exactly. We're talking about 18 agreements, and they are about rail, they're about energy, building various links. And what we are actually seeing which is kind of more controversial in that sense, there's also an agreement that will be signed with Huawei, where the national champion that Hungary has in telecoms is going to develop a joint cloud platform. So that's obviously one controversial thing. And as you said, what he won is obviously this pledge that Hungary does not identify with this description that EU is having for when it comes to exports from China, that there's an overcapacity. This is something that EU has raised several times. Here, Orban and Hungary has positioned themselves as a sort of a hub for EV investment in Hungary. We might, although it's not very clear, get another investment in another factory today. There's already one by BYD. Hungary is also a hub for battery production for the EU. So quite a chunky bit of investments are coming from China to Hungary after this visit.
All right, Piotr, thank you so much for joining us. Of course, we'll continue watching the movements of President Xi throughout the next couple of days as he goes now back home. Now, Europe's electricity consumption has fallen by nearly 10% since a peak in 2008 due to shocks like the global financial crisis and COVID, as well as deindustrialization and slower than expected electrification. But what could change quickly? That could change quickly. That's according to a new research from Goldman Sachs, which predicts a surge in demand, in part driven by the AI data center boom. Well, for more, we're joined by the head of European Utilities Research at Goldman Sachs, Alberto Gandolfi, who's an author of the report. So, Alberto, thank you so much for joining us. I mean, this is a fascinating report because it basically really puts electrification, especially of Europe, at the heart of this new AI revolution. Are we ready if we have more AI, more data center, for how much more electricity we will consume?
Simple answer, and thank you for having me. No, we're not ready. We're not ready because energy transition in Europe has largely focused on developing wind and solar capacity. And it's been quite successful at doing so. What has been neglected is the power grid. And this is fascinating because data by the European Union and Nexans suggests that the EU grid is the oldest in the world, 45 to 50 years old. So we are almost reaching a crunching point where we need to very, very quickly step up investments, particularly in the medium-low voltage power distribution, And we think some regions have understood that. We saw recently E.ON essentially talking about doubling in capex in its power distribution investments in Germany, for instance. But this creates a challenge because not only investments need to go up in Germany, but in every single European country. And the United States are going through a very similar path. So this is going to create pressure on the entire ecosystem, on the entire supply chain. And it's fascinating. And so power grids be beneficiaries, even renewables.
But also in your survey, I mean, you say that, you know, the power consumption could increase, I think, between 40 and 50%. I mean, that's a massive amount of extra electricity that needs to be generated. And I think the time frame you gave for that in the next 3 years, so even if we ramp up, even if officials, companies, politicians force this, we'll never, or will we be able to achieve that in 3 years?
Well, let me be clear. I think in 3 years, we are going to start to see unequivocal evidence about this pattern. We think 40, 50% is a 10-year development, but 10 years is relatively quick in energy market. You know, it takes 3 to 4 years to build an offshore wind park. It takes a year and a half to build onshore. And sometimes permitting is anything from 2 to 7 years. Even grid permitting is very long. So we are already falling behind. And I think actually electrification and data centers, as you correctly said, are the big drivers here. And 9 months ago, 6 months ago, nobody was talking about data centers. And data centers could imply a boost to demand twice as big what we're going to see from electric vehicles. And it's starting right now. So this is why we think that, yes, it's feasible on a 10-year basis, but we need to start now that power demand is not, quote unquote, rocketing yet. Because once you start to see power demand go up 4-5% per year, which probably is 27, 28, that would be way, or 26, that would be way too late.
But Alberto, I mean, some of the conversations that also need to be had is that, you know, getting electricity up, fine, but it depends also on the source of electricity. So if you get electricity through, you know, fuel that's not considered green, then it also will make it harder to wean ourselves and do the transition. So where do you think that the main extra power grid will come from?
But it's a great question. I have to say that because the nature of the clients that require this incremental electricity, you know, the big four, you know, the Microsoft, the Amazon, you know, Google and so on, and Meta. So essentially, those companies have very strict green targets. So they will want a big share of this incremental demand to come from clean sources, which could be wind, solar, could even be nuclear. In certain regions, that's particularly the United States, I would argue. But gas needs to be a transition fuel, as we've been arguing for a while. There are several regions in Europe, Spain is a key example, where there is a very large oversupply of gas plants. So we actually think that several countries in Europe are ready to step up production because we are starting from an oversupply situation, Spain or Nordic. This does not apply to Germany. Germany has to build very quickly, not only renewables, but gas plants. The government is about to auction 15 to 20 billion euros of gas plants that need to be built by 2030. And if these auctions don't happen this year and next year, there's a chance that Germany will already fall behind. So again, it's a race against time. And it's not just clean energy, it's also backup. Because particularly data centers require electricity nearly 24/7 for cooling, for processing the data, for transmitting the data.
So Alberto, talk to me a little bit about what that means for stocks. I know you say you favor these electrification compounders. So what are those? They're companies that you like.
Yeah, electrification compounders are utilities that sometimes in capital markets are considered as dull bond proxies, then, you know, just move with interest rates. This couldn't be further from the truth right now. We are probably at the eve of a generational growth in earnings that the market is completely underestimating. So what are the stocks that we like? There are stocks that have big exposure to power distribution activities that we expect to grow high single digit to low double digit per year between now and mid of the next decade, so in the early 2030s. And those stocks sometimes tend also to develop renewables, which will also benefit. So if you look at a company like E.ON, where 65% of EBITDA is power distribution, in a country largely like Germany, which has completely understood this issue, well, that's definitely a key beneficiary. Other stocks of a similar nature include Enel, SSE, or Iberdrola. Those are the electrification compounders. Then we should put a second group of stocks that are also going to benefit from this. The stocks that develop renewables, the stocks that maybe have a portfolio of power to offer, RWE, Ørsted, EDPR. And those stocks right now price in zero, or in the case of RWE, negative value for future renewable growth. So this is a very big opportunity, potentially at the eve of rate cuts across Europe by central banks, with this structural, secular, organic growth that is going to be independent from any economic cycle in a way, that actually puts these stocks in a very good position, particularly these electrification compounders we talk about. They trade on an average P 2 years out of 10 times. The 20-year P average, so the mid-cycle P average over 20 years, is close to 15 times. That discount doesn't make any sense given the organic growth we see ahead.
Alberto, thank you so much. Alberto Gandolfi, their head of European utilities at Goldman Sachs, with an interesting report out this week. Now, coming up, our interview with the BOE Governor, Andrew Bailey, who indicates that markets are underpricing the pace of easing in the months ahead. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Now, the Bank of England has sent its clearest signal yet that rate cuts are on the horizon, with Andrew Bailey indicating that markets are underpricing the pace of easing in the months ahead. Now, the BOE governor spoke to us yesterday after, well, the 7-2 vote to keep rates on hold.
Our forecasts are conditional on a number of things, but one of the things that obviously are conditional on is we use the market curve to set them up. So I think it's important that if we find that a forecast with the market curve produces a best judgment, which has inflation below target or above target, wherever, but not at target at the sort of horizon, we say so. We say this is where we got to. Best collective judgment is that. Now, it follows, I think, that, and this is the comment I made earlier, that what we're saying is if, and the if is of course critical here, if the world evolves as that forecast suggests it was, well, probably the case would be there for a less restrictive path of policy.
So is
it's
June,
all conditional.
Everything is conditional. Is June a live meeting?
All meetings are live.
So is June likely?
That's a different question. That's different. Look, I think the key points I would make is that we have changed our view on the likely persistence of inflation, on the second round effects. And it's good news. We think there's evidence there to suggest they will be less pronounced than we thought they would be. But that's a judgment, and for me, I'm now looking at particularly these three key indicators: services inflation, pay, and the quantity side of the labour market, to really judge this persistence question, how it will evolve.
But Governor, because you were quite upfront about market expectations, does that come from Ben Bernanke's review, that you will talk more about the markets to indicate more to the markets also what you're doing next?
Well, we're not going to implement the Bernanke review piecemeal. So we're obviously going to spend a few months really sort of thinking quite hard about what we do. And he raised the conditioning assumptions as a point actually, and this question which I think all central banks wrestle with in various ways, which is how do you actually sort of represent a future profile of rates to set up your judgment without sort of getting yourself into a position where you're absolutely nailed on, as it were, for a view of rates 2 years out, which of course is just not realistic to commit to.
But can we expect more market commentary from you going forward?
Well, I think we're in a particular situation at the moment. I've said before, it's a high bar, I think, for us to sort of come out and comment extensively. But I think the point we've made today, and I think have to make, is look, quite a lot of them, when we do the analysis, quite a lot of the market movement of late appears to have been US, in a sense, originated. Now, there's always some of that, of course, but there seems to be more of it. And yet, our analysis would be that inflation dynamics here are different to the inflation dynamics in the US. We're in a very different sort of situation in terms of our economies. So there's a tension in there, and I think that's the point we have to point out.
But this is basically because the Fed maybe overpromised the cuts in December and then couldn't deliver in terms of 2%.
Well, I'm not criticizing the Fed in any sense or judging the Fed. I think the US economy has evolved. I mean, that's the fact. I mean, that's how it's evolved. So I think the way it's evolved has been, if anything, to sort of put in a slightly starker relief the difference of inflation dynamics.
But Governor, are you worried about the second round effects of a cheaper pound?
Well, I mean, the exchange rate hasn't moved sharply, frankly. It's moved a bit, and of course you'd expect that because it's a relative price. So this point I make about different inflation dynamics, you'd expect some, but it hasn't moved sharply. So no, I'm not. We watch it very carefully, but it's not something that. And by the way, as we said, as we always do, in setting up our commentary on the conditioning assumptions this time, actually the exchange rate hasn't moved that much.
Governor, there is an assumption, looking at history, that once you cut, you continue cutting. Now, without prejudging what you'll do, can you give us an idea of how you see the cycle different to 2009?
One thing I would say about this, which is sort of quite interesting, and it's something that we looked at during this round, it's quite interesting in the history of the MPC that most of the cutting cycles in inverted commas, have actually been prompted by some sort of shock or other, rather than being what I might call a natural cyclical sort of, we've reached the top and now we go down the restrictiveness curve. So we don't have a lot of, I would just caution, there isn't a lot of sort of history really to.
So what you're telling us is because you're not cutting in a recession, it could actually be one and done?
Well, I think that would be unusual. But I would say, as I said earlier, nothing's settled, there are no fait accomplis, nothing's ruled out.
Governor, what can you tell us about the play between, of course, interest rates and QT, right? Some may find it confusion because they're pulling in different directions.
So the message we've always given with QT is that QT operates in the background for us. We don't think it has large impacts in terms of markets. But the other point, and this is really the critical point, when we sit down to decide on what the right interest rate setting is, we take into consideration everything, including markets, obviously, and markets will have absorbed, if you like, and taken into account the impact of QT. So, in other words, QT is always there, if you like. If there is any effect from QT, we'll capture it because we'll capture it in the movement of markets, and then we will set bank rate to reflect that.
But you don't think it's confusing for markets? This kind of
I don't think so, no. Don't think so.
So you're not expecting it to end it before the end of the year to make sure that there's no confusion in what you're trying to do with the economy?
I don't think there is, to my mind, any difficulty if we get to the point where we're going to cut interest rates to have QT going on as well.
Well, that was the Bank of England Governor Andrew Bailey talking to us yesterday. Now, coming up, IAG reports strong summer travel demand in Europe and across the Atlantic in its first quarter results. More on the numbers from the owner of British Airways next, and this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Now, the British Airways parent IAG has reported summer travel demand is strong in Europe and across the Atlantic in its first quarter earnings. Now, let's get more with Bloomberg's Sid Phillips. Sid, I mean, this is an amazing story because basically a lot of people, me included, book well in advance for their travel holiday. So what does it tell us about the bright spots for the travel industry going forward?
So British Airways is obviously focused on transatlantic travel, and IAG, the broader group, which owns Iberia and Aer Lingus, is also focused on Latin America. And so they've seen a lot of demand for travel into those places, as well as intra-European travel. And I think that sort of shows that people are still sort of resilient in terms of booking their holidays. And essentially what will be key is fares and where fares go in terms of determining profitability. I mean, summer is the most important travel season for the airline industry. And so essentially this is crucial for them to make their money. And they seem to be more bullish about the prospects than the rest of the industry.
So turning to Boeing, because you cover a lot. Turning to Boeing, why is the SEC now looking into the statements made by the company?
So the SEC is, at the moment is looking into statements made by Boeing in the aftermath of the Alaska Airlines incident when the door plug blew out on the 5th of January. And they're looking to see if Boeing executives made comments that potentially misled investors. Not all SEC investigations result in any sort of charges, and it could well be that there's nothing there to be seen, but it is significant because they're looking into Boeing's conduct essentially in the aftermath of that incident to see what really went on there.
Sid, as always, thank you so much for joining us. Sid Phillip there with the very latest, of course, on all of this news out there when it comes to travel and planes. Now, Formula E is now in its 10th season, and as the sport grows in popularity, questions are being asked about the championship's carbon footprint and net zero targets. Now, for more on this, let's go to Bloomberg's Oliver Crook, who's at the Formula E circuit in central Berlin. Ollie, good morning. You have a pretty good gig, so you spoke to the chief executive ahead of another big race. What can you tell us?
Yeah, that's right, Francine. So we're at the Tempelhof Airport here. This is really a 1920s airport here in Germany, but really today containing the future of racing, potentially in Formula E. We've got the race that's coming up tomorrow and over the weekend. As you can see, all of the car companies here that are preparing their cars. This is the Cupra team here behind me. And yeah, speaking to the CEO really about this business and thinking about this business, this is only 10 years old, Francine. So there are a ton of challenges for this business to try to overtake, say, Formula One that has literally billions of dollars in sponsorship, an absolutely huge fan base, but there's also a huge opportunity. I mean, the technology in these cars is changing so swiftly. The new generation of these cars is going to be 30 seconds, is going to be 30% faster. And so I talked to him also about attracting new car companies and trying to get the Chinese players into Formula E. Have a listen.
Absolutely see a BYD team. I could see a Geely Group team like Lotus or Zeekr, SAIC, who obviously own brands like MG across the... So absolutely I can see a Chinese team. We actually have two Chinese teams here. We have ERT, but we also have Envision.
What about a Tesla team?
I think Tesla's unlikely, and I'll tell you why I think it's unlikely. So all of the teams here are racing on a common battery. So I'm not sure that Tesla would be so keen to run on a battery that isn't their own.
And Francine, the other reason he said that there probably won't be a Tesla team, because if they're new to the sport, they'll probably lose. Never maybe a good idea to challenge Elon Musk quite like that.
Never a good idea. That much we all know. Or maybe it's a good idea. Ollie Crook there at the Formula E circuit in central Berlin. Well, Bloomberg Brief is up next, and this is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Manus Cranny. Welcome to Bloomberg Brief. Let's set your agenda. A Bloomberg scoop: the U.S. is set to impose tariffs on Chinese EVs and strategic sectors as soon as next week. Benjamin Netanyahu says Israel will stand alone in the fight if it must, after Biden's withholding of a bomb shipment. Plus, details on Apple's ambitious plans to infuse its devices with AI capabilities. All hail AI, and all hail the prospect of more rate cuts. That's what took you to up over 5,200 on the S&P 500. Is that what is the definition of risk as we go to Friday? That we are bulled up on 2 potential rate cuts from the United States of America. Doug Ramsey over at Luthold says there's another 10% left in this market if this construct of a bull market remains. GDP now, it is at over 4%. I know it's a volatile number. Keep an eye on Tesla, never far from our mind. Stock is up 1.25% at the moment. 2 different stories here. One is that BP could be interested in buying the supercharger complex here in the United States of America. And there's a new fresh headline from Elon Musk. He's going to spend $500 million on, you got it, supercharging. Yes, he asked everybody last week, 500 people went, but he's in there with $500 million. Bonds, the 10-year auction, the 30-year auction went mighty fine, 2.49 times bid to cover ratio. So that's pretty much at the money. Daily of San Francisco asks for more time. This bond market is prevaricating at the moment. Does it bank on 2 cuts or potentially a little bit more? Oil is bid up 1/3 of 1%. Goldman Sachs talk about an extension of the OPEC Plus agreement coming up. You're above the 100-day moving average, and Macquarie see a ramp up in Middle East tensions as abating, and so therefore your supply risk is a little bit lower. We're bid on Brent this morning. As I say, a lot of the complex is all predicated on this return of the rate cuts, and that's on the jobless claims from yesterday. 1 print, and the home market reprices. Anyway, President Biden is set to unveil fresh tariffs. As I said, it's a Bloomberg scoop on Chinese EVs, batteries, and solar cells as soon as next week. Craig Trudell is with me. So what exactly, Craig, good morning to you. What exactly is the Biden administration planning to do, and why now?
Yeah, I think this is really a move on the Biden administration to, keep in place existing tariffs and in some cases implement some new ones and do so in a targeted fashion to really hit industries where China, has potentially a competitive advantage. And I think, EVs and batteries being front and center there, at least in my little world, I do think that, we've seen the car industry make quite a bit of noise about the threat that is posed by Chinese electric vehicle makers, even from the likes of Elon Musk, really sort of tipping his cap to just how competitive these companies are, how low they've managed to bring costs. And, I think a real concern on the part of union members of a union like the United Auto Workers of, the possibility that this industry, could disrupt their workforce and really have an effect on employment in the U.S.
Yeah, I mean, I suppose if we go back in time and we look at those Japanese manufacturers, and the same arguments were made by many countries, and then we had what was called competition for the consumer. There you go. It's a radical thought. Now, talk to me about the impact that this could have on the EV sector in China. How could this really come down for BYD?
I think what's really interesting here is that a company like BYD has already sort of viewed the U.S. as really close off to them. And, the U.S. administration already, under Trump, raised tariffs to a significant degree on Chinese vehicles. There's been, talk and looking in Washington at increasing tariffs and blocking EVs on national security grounds. So I think, we're in a state where these companies already have sort of ruled out the idea that this market is attractive to them. They're looking more so at Europe already. And I think even as we potentially see incremental tariffs here, it will still be a more open market than the U.S.
Okay, well, it's certainly not going to go away, the whole issue of tariffs, targeted or broad, depending on who's in that White House in a couple of months' time. Craig, thank you very much. Craig Trudell setting the stage with the Bloomberg Scoop. Sonja Martin is my guest this morning, head of FX and monetary policy at DZ Bank. You know, Sonja, the road to hell is paved with good political intentions, isn't it? And here is the Biden stall. We understand. We'll get more details next week. But either way, tariffs are going to live, and they're possibly going to live longer and higher if there's a change of administration in the White House. We're seeing a small reaction in high beta of Aussie and Yuan this morning, but your first take on the prospect of more targeted sanctions, on more targeted tariffs, excuse me.
Well, I mean, obviously, the big question is, why is this coming now? I mean, as you commented, just mentioned, I mean, it's sort of been the Biden's administration's policy to have tariffs in place. I mean, they haven't exactly been much kinder in that regard than Trump is. But now there's an election coming, and I feel that maybe this is also an attempt to take away some of the trade discussion away from the Trump camp, and to show that the Biden administration as well would still take action vis-a-vis particularly China. As far as the currency market is concerned, as you mentioned, there hasn't been much of an impact, and I think there won't be, because currently, well, first of all, we're still lacking some detail, but also I think the market is really looking for the election and the threat of a Trump win, which would then, of course, mean probably an escalation of the whole tariff situation, and that would have a much bigger impact on this market.
Will it have a much bigger impact in terms of inflation? I want to get a sense from you of where we are. Yes, we saw quite a bit of a shift in narrative. 1 week's jobless claims of over 230,000. Apparently it's because the New York schools closed for a break. But I want to get a sense from you. A lot of the idiosyncratic data at the moment is bumping into one another, isn't it? And this is what Veronica Clark had to say over at Citi. The evidence is building that the labor market is poised for a sharp weakening. Labor market indicators are flashing yellow or red, and they're raising concerns about a non-linear rise in unemployment. Now, as Danny and we chatted to one another this morning, she'll be on later, this brings back the dual mandate aspect. It could make a reappearance. You've got to cut for jobs, not for inflation. Are the indicators flashing yellow for you at the moment? Is there enough there to be worried?
No, I don't think that it's fair to say that they're flashing anything at this moment. I mean, we have seen a couple of slightly weaker prints, slightly weaker. I mean, this labor market is still very, very strong. And it's just one of those things that we've been seeing for the last 6 months. I mean, markets just rushing from one extreme into the next. I mean, remember earlier this year, 160 basis points of rate cuts were priced in, and it's all been priced down. There was talk about rate hikes. Suddenly we get 2 or 3 prints of slightly softer data, and everyone's rushing to the opposite direction again. It's just uncertainty. I think people feel very unsure about where things are going to go, and I think have very little conviction, and with this leads to these massively volatile swings. I mean, the US is obviously experiencing a very, very mild slowdown, but I mean, I don't think we're at this point where we have to talk about flashing warning signals. And I think, let's be honest, we've been sort of waiting for this labor market to weaken for a really long time. And I think at this point we can probably safely say that a massive weakening isn't going to happen.
Okay, and with that backdrop, I mean, the dollar has been exceptional. U.S. exceptionalism is a dominant force. Divergence and Fed remaining higher for longer relative to their peers. I look at the G10 complex. There's not one currency has challenged the dollar. The yen's on its knees. The Swiss franc is under pressure. And the Norwegian krone has also dropped by over 6%. So if we're at 2 cuts in the USA and 3 potentially in Europe, do you throw in your parity call? Because you say the euro has held up quite well. So I'm curious to get an update. It's like we bring you on once a month. What the heck? Why not? Let's have an update on the parity call.
Well, we still have we have the Trump parity to call. If Trump wins the election, we still think that the euro has significant downside. But assuming that Biden wins, and over the next few months as well, I don't think that's going to happen. Simply because as you mentioned, the market is pricing in 2 cuts for the Fed. It's pricing in 3 for the ECB. We've seen this all being priced in, and we're still trading where we are trading today. So I fail to see the surprise in Europe. If anything, the data has been slightly better than expected. I mean, it's a mild recovery from really low levels, but it's getting better. And in the US, I think we've priced in about all the good surprise, or the positive surprise that we can. So I don't really see what's going to push your dollar down, unless, of course, we get a clear lead for Trump in the vote and in the polls, and I think that will be dollar supportive. But unless that happens, I'm not a big fan of the parity still.
Okay, well, we just thought we'd check in with you on that. Now, look, I applaud everybody in this market. I applaud bond traders, equity traders, but I hand a gold prize to the FX traders because they just want to test the Bank of Japan and the Ministry of Finance. They go, come on, come on. Come on, is that all you got? 60 billion. Show me a little bit more. I mean, if you look at Ueda, I mean, nobody really, he's losing credibility because he's talking about a monetary policy response. So he's vaulted from, a dovish situation to talking about a monetary policy response, and still the FX market go sell yen, sell yen, sell yen. So where?
My general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Against President Biden on the war in Gaza. More on this story next. Context matters on Bloomberg.
best of financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I've known Joe Biden for many years, so 40 years and more. You know, we often had our agreements, but we've had our disagreements. We've been able to overcome them. I hope we can overcome them now, but we will do what we have to do to protect our country. If Israel has to stand alone, we'll stand alone.
Israeli Prime Minister Benjamin Netanyahu there standing up against President Biden on the war on Gaza. Now, this was after his U.S. counterpart warns of a suspension on additional shipments of offensive weapons if Israel attacks Rafah. Mark Champion is with us, Bloomberg Opinion, joining me now. So the international cost to Israel of sending the IDF into Rafah is clearly rising. Mark, what is the Israeli argument for why they need to continue to do this?
Yeah, I mean, they're very clear that they reject the idea that the cost of doing this, that they will end up with a strategic defeat from any kind of, battlefield victory in Rafah. What they say is that, everybody's telling us that we have to look to the sort of day after plan. They say we don't have one. They say that we need an alternate, administration to put in place instead of Hamas, that we need to get peacekeepers or some other force to come in and so that we don't have to occupy. That can't happen, the Israelis say, if there are 4 battalions of Hamas troops intact with their commanders in Rafah. They will simply take control, and they will make it too dangerous for anybody to kind of move in and try to disarm Hamas or to take control. So that's their point of view, that this just has to be done for any kind of longer-term scenario that everyone says that Israel should be developing to take place.
And what about the million? The million Palestinians? It's a country that's ravaged. There's very few places to go. This is the result of war. We understand that. But you have this deep concentration in Rafah. And I want to know what has been said about that. I mean, the U.S., this is part of the U.S.'s position, isn't it, in terms of pushing back on Benjamin Netanyahu? Where can they go? What is the reality on the ground?
Well, the reality is going to be, it seems to be almost impossible. It has to be said that they did declare an evacuation zone east of Rafah. The UN says that about 80,000 people have moved out in the last couple of days. In fact, a Sky investigation, using satellite imagery, says that quite a lot more than that have moved. Mainly from the evacuation zone, but also from other parts of Rafah. Most of the people who are there, most of those million people, are not from Rafah. They came from other parts of Gaza, so they're familiar with what happens when the Israelis move in, and they are starting to move out. The problem really is that the Israelis have this time, built some infrastructure for them to go to. They've bought some tens of thousands of tents. But it simply isn't going to be enough for the numbers that we're talking about, and it seems like not on the time scale that the Israelis have in mind.
Okay, well, it's certainly going to take more than tens of thousands of tents to cover that number of people. Mark, let's see how the situation evolves over the weekend. We'll return to this, I'm sure. Mark Champion with the very latest from Benjamin Netanyahu. A quick snapshot of what's going on across the commodity complex this morning. There are a number of things to keep an eye on. You've got copper above $10,000. Is it FOMO? Macquarie warns that it's a FOMO-driven rally. There's a risk of a pullback in that. But there is something of note. Supply worries seem to be faltering. LME inventories are dropping. Gold is bid by 1.125%, up the most in 3 weeks. We're at the highest in 3 weeks. Again, calls out there for $2,500 from ANZ, and crude up 0.5%.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
It is Bloomberg Brief this Friday morning. I'm Manus Cranny in New York. Let's get you up to speed with the front pages from around the world. This is what's making the headlines. First up, it is the Financial Times. American public pension plan CalPERS is mulling a vote against Exxon CEO Darren Woods' re-election to the board. The shareholder discontent brews over a lawsuit. Exxon has sued two climate-focused investors. Next up, it is on the front page of the Journal. The former presidential hopeful Nikki Haley has no plans to endorse Trump, well, at least not yet. Now, we understand that she met some of her biggest donors. That's on the slate for next week, but it's not expected to discuss her political future, I should say. And UBS considering a new reward system for their investment bankers. Refer your wealthy friends, bring them into wealth management. That's it. So the bankers in Asia and Europe could be in line for a little bit of a payout. Let's bring in Charlie Wells to discuss this. This has all the hallmarks of Iqbal Khan, really back in charge. This is a very Credit Suisse orientated flavor, bringing it to UBS live.
That's exactly right. I mean, this is not something that UBS has previously done, but Credit Suisse and Con famously did. So they used their more muscular investment bank, particularly in the United States, to bring in clients that they effectively helped make rich with their deal making, with their advisory, and bring them into that wealth management fold. Now, what is also really interesting about this is this shows that Sergio Ermotti does not just want to integrate Credit Suisse and UBS, he wants to grow that combined business. And this is the way that he wants to do it. He wants to do it by using that investment bank, by potentially, according to people familiar with the matter, bringing in some of those wealthy clients. This is evidence of that strategy potentially coming to play.
Well, there's no doubt about it. I mean, Iqbal Khan, many things were said about his desire to grow the lending book more aggressively, perhaps, than the parameters within UBS. But what could go wrong?
I mean, Manus, I'm thinking of something. It starts with an A, there's an R in the middle, and it ends with Pigos.
Yeah.
So, client relationships are important, but so is client vetting. And I think the sort of ironic thing here is that, this is UBS looking to investment banking. Of course, coming from Credit Suisse, that was one of the more troubled units of that bank. There's also a lot of competition here, right? I think we talk about wealth management in the banking space almost as a panacea, as a sort of cure-all or a huge growth driver, which of course it is. There are trillions of dollars at stake here, but everyone wants to get in on this, right?
Exactly.
And lastly, there's that cultural element as well of, you're potentially rewarding the investment bankers in that clubby private world of private banking.
Indeed, and that is exactly what the chairman wanted to push back against in terms of that perhaps culture from Credit Suisse into UBS. Coming up, we're going to catch up with the CEO of EDP.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg.
From our global headquarters in New York, I'm Menace Crenny. Let's set your agenda. A Bloomberg scoop, the U.S. is set to impose tariffs on Chinese EVs and strategic sectors as soon as next week. Benjamin Netanyahu says Israel will stand alone in the fight if it must, after Biden's withholding of bomb shipments. Plus, details of Apple's ambitious plans to infuse its devices with AI capabilities. A very good morning. We got there. We got to Friday. The only thing that blew up was really the jobless claims yesterday, which infused a narrative of rate cuts, potentially more back on the table. Tesla has been higher this morning, up by 0.7%. We're seeing news flow come through that BP may be interested in the supercharger assets of Tesla. And then we have a headline from Elon Musk saying he's prepared to spend $500 million on, you got it, superchargers. So go figure. 500 people were let go from that unit last week. S&P futures up 1/3%. You know, you're going to need strong delivery on your numbers, otherwise this market really does punish you. GDP, the GDP Now survey is over 4%, so you've got a strong economy, rate cuts narrative abound. Bonds are fairly flat. The bid to cover ratio on the 30-year auction yesterday was fairly solid. $25 billion worth of bonds were taken. Mary Daly asks for more time in terms of the narrative of when to cut. Oil is better bid this morning. You're above your 100-day moving average on Brent. 1.5% is what we've put on over the past 3 days. Goldman's talk of an extension in the OPEC Plus cuts at the June meeting in Vienna. So oil is bid. We're fairly risk on as we start this trading day on Friday. Let's turn our attention to the world of renewables. The utility company, EDP, says investment will decelerate over the next 2 years. This as it focuses on its top projects. The market liked that. EDP is one of Europe's biggest wind energy developers with projects across the region and here in the United States of America. Joining me now is Miguel Stillwell Dandrade, the CEO of EDP. Good to have you with us. Look, the market gave you a bit of a cheer yesterday. You're becoming more focused on what it is that makes money. But you did cut your guidance on the renewables business by 25% over the next couple of years. Was that just a truth and reconciliation moment for you, or what is it that led to that quite dramatic cut?
Hi, good morning, and Menace, it's a pleasure to be here. I'd start off by saying that it's really reacting to the current market environment. I mean, clearly we're seeing energy prices have come down dramatically in Europe from where they were sort of a year ago or 2 years ago. And on the other hand, we have interest rates that higher for longer. And I think that's particularly true in the US. Even in Europe, there's some expectation that they might come down. But in any case, we are seeing this cost of capital being higher. And so we're obviously very focused on keeping a solid balance sheet, BBB balance sheet. We have a strong dividend policy as well that we're maintaining. And so we're adjusting our investment basically to these two factors. And basically, it's still going to be a very strong growth plan. We're talking about 17 billion euros that we will be investing over the next 3 years, and a very strong compound annual growth rate, sort of in the double digit.
Look, your headwinds are significant. Spanish electricity prices registering negative for the first time. Portuguese prices are on the floor. I mean, are you trying to call... Nobody can call the bottom of the top of a market. I'm not going to ask you something as banal as that. But is this the worst kind of case scenario that we're in at the moment? Do you see this as being a floor in prices?
Well, I think it's down to levels that we had sort of pre-pandemic and pre-energy crisis. And so I think it's levels that we could consider would be sustainable over the long term. Now, obviously, prices can fluctuate, and who knows where they'll be in 6 months or in a year's time. It could be up or down. But let's say this is a more reasonable level. Clearly, a year ago, we were seeing much higher prices, not only at the time, but also for 24, 25, and 26. And that has come down significantly. And so I'd say at these levels, we feel comfortable that, you know, it won't deviate much further from this, certainly not on the downward side. But let's see. This is very dependent on gas prices as well as in Europe. And gas prices, as you know, have also come down dramatically in Europe as a result of much lower demand on one hand and a lot more supply, I think, than people were expecting, and a much milder winter.
Or perhaps it is that the rampage of the hedge funds in the electricity and the gas markets has abated. We can debate that on another day. I'd like to focus on the US. Obviously, here we have the Inflation Reduction Act, much fanfare and delivery, and the distance is quite phenomenal. But when I look at the meltdown in the clean energy sector here, the stocks in the clean energy sector here over the past year, How much of a cautionary tale is that? I mean, that's a market reaction, but how much caution do you have about expanding in the United States of America?
So we think the U.S. is a fantastic market for renewables. We've been in the U.S. since 2007. We're one of the top 5 renewable players in the U.S., and we continue to see very strong growth prospects going forward, particularly with the Inflation Reduction Act. I think there was quite a lot of hype, as cycles go. There's a lot of hype back in 2021 and 22, obviously with the new administration coming in 21, and then Inflation Reduction Act in 2022. And so that was built up. I think things have recalibrated. And what we're seeing is that the credible players, such as ourselves, I think, we are in here for the long term. And so we didn't maybe get carried away with the hype, but we're also certainly not depressed. And we continue to see very attractive projects. Perhaps this is one of the better times that we've seen for investing in the U.S. Very high single-digit IRRs, so for the wind and solar projects and also for storage. So actually, we're quite optimistic about the prospect going forward in the U.S.
Well, you talked about a strong balance sheet, and then the corollary to that is you must be ready to use some of the dry powder on the balance sheet. So are you ready to bid for energy projects here? If you have to have a choice on how to grow the business here, will it be through bidding for, let's say, wind energy offshore? Is that the plan, to be more deploying of capital here in the United States of America?
So about 40% of our overall global investment goes into the U.S. And as I said, we've been in the U.S. since 2007. We're based out of Houston, but we've got projects in more than 20 different states. And we are particularly strong in wind, but we've got a growing presence also in solar and in storage. We also have offshore projects, particularly up in Massachusetts. We have a big project called South Coast Wind. We've got one in.
And are you ready?
New York
I suppose the question is really, are you ready to actively buy more assets here?
Not buy, but develop. We've been investing. So organically, we have a good portfolio, and that's what we're focused on. We're not focusing on buying other assets. We're focused on developing our own assets, and we think that's where we'll get the best returns.
Which then takes me to get your opinion on the Inflation Reduction Act. Much fanfare, much hype, as you say, a couple of years ago. Reality and delivery is something different. In a succinct answer, if you can, is the Inflation Reduction Act fit for purpose? Is it working efficiently? You've interacted with it. Give me your take.
Definitely very fit for purpose. Long-term plan, gives predictability and stability in terms of the investments for renewable companies like ourselves. And so clearly something that was a big consequential piece of legislation that we fully support.
The risk is this, that you have either Biden Mark II as we go into 2025, or we have a new administration. And with the potential of a Trump administration, there are risks to the IRA. Would that materially, do you think that could materially impact renewable investing in the United States of America if there's any step back from IRA? Or would it materially impact you? You said to me, I'm here for the long run. But if the policy changes, you must adapt.
For sure. But I mean, we've invested throughout the Trump administration, and we had a very successful run also in terms of growth during that period. So definitely the Inflation Reduction Act is something that we think will be there independent of the administrations. There's a strong, I believe nowadays, bipartisan support for the majority of it. They might play with it some at the margin. But if you think that 80% of the investments coming out of the Inflation Reduction Act are actually going to Republican states, I think that says a lot about, say, the buy-in in terms of keeping it sort of in place. Some of our biggest markets are Texas, Indiana, deeply Republican states, and where we're creating jobs, we're creating employment, sort of cheap energy, economic growth. So why wouldn't you keep it?
Well, if it's not broken, don't. Some people say don't tinker with it. Just let's close off here. We debate inflation every day on these TV shows. We get together with CEOs like you, and we get a sense that the supply side of the inflation narrative, those bottlenecks, has abated. If I look at your supply chains, do you have enough of everything that you need on solar panels and wind turbine equipment? Is there any kind of shortages for you that can perhaps stymie your development and your growth plans?
I think the industry is in a much better place now than it was over the last 2 years. I think over the last 2 years, particularly in the U.S., there was a severe shortages of solar panels, for example. Most of them were being imported. There are things like the Uyghur Forced Labor Protection Act, which imposed much more stringent requirements on the importation of solar panels, and that slowed down substantially let's say the buildup of that supply chain. That has now changed. We've pivoted. We now have several suppliers, most of them US-based. And so to the extent that we can continue to supply our projects in the US with US-made panels, I think that's a big part of de-risking our supply chain. Obviously, there is also an issue around price. So it's not just a question of, can you get the quantities necessary, but what is the price?
Yeah.
Obviously, the US has imposed also tariffs, and so that has driven up prices. In any case, we are seeing people relocate. And the IRA, the Inflation Reduction Act, provides a lot of incentives for projects and panels and supply chain, so that is actually based in the US. So over time, we think that the costs will continue to come down, and it will be competitive as it is with in other regions and other parts of the world.
Miguel, great to get you on the show. When you're in the States, you do so much business here. You must be through quite often. Next time, please come and join Danny and myself. Good to have a conversation. It's going to be a punchy old year. Let's see how the future plays out for you. Miguel Stillwell Andrade, the CEO of EDP. Coming up, Apple's new strategy will discuss its sweeping effort to infuse its devices with AI capabilities. Context matters on Bloomberg.
Has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Menace Crenny in New York. President Biden is said to impose tariffs on China's EVs as soon as next week. That's according to people familiar with the matter. Now, it represents one of Biden's biggest moves in the economic race with China. For more on this scoop, let's bring in Bloomberg's Oliver Crook, who's actually down at the Formula E circuit in central Berlin. More on the reason why he's there in just a moment. Ollie, you get all the choice locations, but you've spoken to a lot of these Chinese EV makers over time. How big a problem is this going to be? I mean, we don't exactly know the details yet, but give me your take.
Yeah, so Manis, we've spoken to, the likes of BYD, NIO, a lot of these car makers that have really been putting a lot of their energy into pushing into here, the European markets, and that's in large part because this has always been seen as a risk. While this is a significant move, it's perhaps most significant in terms of the political signaling, i.e. how Biden is going to position himself vis-a-vis the Chinese politically and economically. But for many of these car manufacturers, they honestly were not even trying to touch the United States market because it just was seen as too complicated, too difficult, which really emphasizes how important Europe is for the likes of BYD, for the likes of NIO, for all of these car companies in trying to push forward. So maybe the thing to look forward to, Manis, is that EV probe that's going on right now from the EU Commission, which we will get preliminary results from at the beginning of next month, which could mean tariffs as soon as July of this year in Europe, which I think would be a much more significant development.
Yeah, well, Ursula von der Leyen in that meeting with Xi Jinping and Macron just the other day, really sort of emphasizing about excessive dumping, etc., and excessive moves by China. So come on then, you're on a racetrack, you're getting the glamour gigs. My days of this is obviously past. You're at Formula E. I'm more Formula One myself, but you're in Berlin. So talk me through Formula E.
You are Formula One, Manis.
I know. But look, talk to me about how fast, this is growing in terms of the EVs market. Ollie.
So listen, man, we're right in the middle of the season here. We're in Berlin, so they just came from Monaco, and next stop is Shanghai. So they're really trying to position themselves as a global business. As I can see behind me, all the teams in their pits, they're getting ready for the race tomorrow. What's interesting, though, is, Manis, this is a 10-year-old business. This is barely, sort of in existence as far as a sport comes. And trying to build a sport from zero is very challenging, particularly when you're going up against something like Formula One, which has a huge established history with all of this sort of fan base and billions and dollars worth of sponsorship. But the opportunity is there too. A lot of these cars, Manis, there is technology changing on this every single year. The next car they're going to come out with is going to be 30% faster in terms of acceleration. It is going to be faster than the Formula One car in terms of just acceleration. So I spoke to the CEO, Jeff Dodds, about how do you compete on a totally brand new sport.
Very large investors in Liberty Global, Warner Brothers Discovery. But as I say, this is a business that's only 10 years old. So they're investing for what they believe the future of this business could be. I think fan base, though, is a good proxy. So when I started about a year ago, the fan base in Formula E was about 290 million fans globally. As of now, the latest time we did the big survey, it was up to nearly 400 million fans. So around 30% growth in a year. This is a business that's growing exceptionally quickly.
And in terms of the other thing that you need to do is also attracting other OEMs, other manufacturers to the sport, right? There was Mercedes, BMW, they stepped back. What I'm surprised by is that there are not more Chinese automakers fully who have really dominated the EV race. Are you in conversations with them?
Oh, yeah, of course. So you have the big Chinese automotive groups. So BYD now becoming prevalent across the world. In fact, I think the biggest EV manufacturer now in the world. You've got Geely Group.
Could you see a BYD team in the next couple of years?
I could absolutely see a BYD team. I could see a Geely Group team like Lotus or Zeekr, SAIC, who obviously own brands like MG across the... So absolutely I can see a Chinese team. We actually have two Chinese teams here. We have ERT, but we also have Envision.
What about a Tesla team?
I think Tesla's unlikely, and I'll tell you why I think it's unlikely. So all of the teams here are racing on a common battery. So I'm not sure that Tesla would be so keen to run on a battery that isn't their own. The second thing for Tesla, I would say, is they are the dominant force in the electric vehicle manufacture. They were the people that started it all pretty much with the Roadster. I'm not sure, they don't need the exposure, so they don't need the PR around it. And the final thing I would say is a lot of the teams here have been racing in Formula E for a long time. Tesla would not be competitive from day one, and I'm not sure how that would fit with
that. Sounds like a challenge to Elon Musk, which is always a dangerous thing to do.
It's never dangerous. I would love Elon to call me. I'm just not sure it would be top of their list.
So maybe the headline there, Manis, is that Tesla would not be competitive. Always a dangerous philosophy to kind of challenge Elon Musk. But I thought it was interesting to say that, you could have these Chinese OEMs coming to this, really a BYD sometime soon. And just to tie it back to the EV story more broadly, this is exactly the kind of exposure that the Chinese automakers would want to get a foothold within the European market.
Yeah, you just make sure that you focus on reporting, reportage. You're not Lewis Hamilton, and you're not hopping off to, Formula EV. Ollie, great work. And a great package. Enjoy the weekend and the sport. Oliver Crook in Berlin. Well, the tech companies have a strong focus on artificial intelligence, and the guests at Bloomberg Tech Summit had this to say about the future of technology.
I think 2024 is going to be a monumental year for AI.
The current generation of models that we're seeing out there is still in the $100 million range. You know, I think all of this can scale to the $100 billion range.
Llama 3 should not be open source. It's a national security hazard to open source.
We are trying to be the most responsible actors that we can be, and think about what are the potential externalities that could be caused kind of accidentally by this tech.
I also worry about the overhyping of human extinction risk. I think that is blown out of control.
I feel like today, every single company has to build their own AI. Otherwise, they run the risk of being left behind.
Well, let's stay in that space. Apple will deliver some of its upcoming AI features this year via data centers. Now, it's equipped with their own in-house processors. It's part of a sweeping effort to infuse its devices with AI capabilities. Mark Bergen is with me. So this is a curtain raiser, potentially, on what Apple's ambitions are within AI and their own processors. Talk me through it.
Yeah, this is something we're expecting them to lay out their strategy in June for the developer conference. We'll just continue with the Formula E theme here. It's like Apple has the most attractive car in the race, but there's a real risk that they're going to be lapped by Google and Microsoft. And this is a world in which these, it's our Bloomberg Technology Conference yesterday. This is a world in which a lot of people in the Valley are imagining, and certainly Apple's aware of, the future where AI is living a lot more on our devices, where there's something kind of beyond the iPhone that is driven by AI, something that we've reported that Johnny Ive, the legendary former Apple designer, is maybe working on with OpenAI's chief. And this is, one way to think about this change that we talk on the server chip side is they're basically kind of turning Siri from an also-ran into something that really is competitive with ChatGPT and this next generation of AI products. And that means they have to use these much more powerful chips that are kind of provided for the cloud rather than on the device themselves.
Now, I mean, I think you put it very, very nicely in terms of Apple being lapped by the others. I mean, are the others so far ahead in the sort of the chip side? But, Apple can make up for that in other ways, I presume, in the AI competition.
So on the chip side, Apple certainly, they tend to do things pretty vertically, right? That's something they prefer to do. We think about this, if you think about it in search, though, Apple obviously has its own search services, but they rely on Google, this multi-billion-dollar year deal. I think we've reported that they're in talks with OpenAI and Google as well to kind of bring whatever Gemini, ChatGPT, this our next generation of AI-powered search to iPhone devices. I imagine there's a world in which Apple wants to do that themselves, right? Like some services revenue is something that Tim Cook has been talking about a lot. If you think about the future of Apple moving beyond the iPhone, it is having the AI that can work with their VR devices, whatever they're doing in automotive, whatever they're doing sort of in the home devices. This is critical to the company. They've been hiring a lot. They have, Google's former AI chief is now running their division. Okay. But it's something that's sort of a cultural clash that the Apple's had to work through.
Mark, thank you so much. Mark Bergen there on the Apple AI story. Coming up, we'll set your agenda for the trading day right here on Bloomberg. Context matters.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Here's Bloomberg Brief with me, Manus Cranny in New York, and look at what's ahead for you today. The ECB, they will publish the account of the April policy meeting, 7:30 a.m. Eastern. All eyes down on that. And more Fed speak. Bowman, Goolsbee, Kashkari, all talking throughout the day. As Daly, of course, yesterday called for more time. Then you've got the University of Michigan sentiment numbers. They come out at 10 a.m. Eastern. All eyes down on that. We've had the flow show through from Bank of America. We'll talk you through that in a moment. Let's just show you what's going on with a couple of individual stocks. We've mentioned Tesla through the morning. It's up nearly 1%. Musk, we understand, will now spend $500 million on supercharger network. Now, this is as BP. We understand BP's electric vehicle charging arm is eager to snap up the Tesla supercharging sites across the United States of America. TSMC up 3.33%. Sales are jumping on sustained AI demand, so that's going quite nicely. NVIDIA, FPT acquired its first NVIDIA server in part of its plan for an AI factory in Vietnam. That's it for me. Danny will be up with Jonathan shortly in surveillance. Equities are bid 3 weeks in a row, and you've had the biggest inflows into the bond market since July 2021 on a no-landing scenario. That's the Bank of America, Michael Hartnett. The flow show, no landing, and the money flows into bonds. Good morning from Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, You've already taken the gold. I go, that's right. I'm always going to be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Market can live with an environment where growth is strong and maybe the Fed only cuts a couple times.
What makes me question the degree of restrictiveness is really the strong activity data that we continue to see.
The Fed are very focused on that domestic labor market dynamic, and I think that will continue to be the case.
If there isn't more of that dovish pause type of language, this is a market which is a bit more vulnerable.
We're still in the early innings of seeing the data really cool in the way that the market wants it to.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, heading towards 3 weeks of gains on the S&P 500. Before we get to the weekend, already looking forward to next week. Just look at the lineup. Absolutely stacked, full of economic data. PPI on Tuesday, Wednesday, CPI and retail sales. Thursday, jobless claims. You've got some retail earnings in the mix as well. You'll hear from Home Depot and Walmart. By the end of next week, Danny Berger, we should have a decent read on the American consumer.
Let us hope so, because at this point, it feels like every piece of data that's come in is just choose your own adventure. You decide with the data that comes in what you think about this economy. It's been contradictions. ISM goes into contraction. Some consumer stocks had bad earnings, but earnings overall is great. And GDP Now tracker, 4%. Make sense of that, John.
The same as last week, Danny, in many ways whipsawed by the economic data. You all remember last Tuesday, hot ECI. Fed might have to talk about raising interest rates at a Wednesday meeting. Then all of a sudden, a cooler payrolls read. Just whipsawed narrative from one side to the other. More Fed speak a little bit later. Talk about lineups. Fed speak. Just repeat the same line again and again and again. You'll hear from Bowman, Logan, Kashgari, Goolsby, Barr, and Mester. And what we heard from Daly yesterday, Danny, we are restrictive. It might take more time to just bring inflation down. More time seems to be the phrase on repeat.
Yeah, I was going to say replace Daly with literally any other Fed speaker, and that's all you've gotten over the past few weeks. Because, John, we used to trade on this idea, don't trade on what the Fed should do. Trade on what they will do. We don't know what they're going to do anymore because they don't know what they're going to do anymore. So we get this same refrain that essentially tells us nothing.
We have a decent idea of their reaction function, which is what a lot of people around this table have been talking about over the last couple of weeks. Just the idea that we don't have to be afraid of strong data, they won't hike. But if we get soft data, they will ease. How well do you think we're set up for that going into next week, given the move down we've seen in yields across the curve from the 2-year out to 10s?
Well, the animal spirits have been unleashed. So basically, this market is set up as if we are in the cutting cycle, John. If we get anything contradictory towards that, what happens to this market where you've seen all these people flood to the bond market because spreads are so thin, when you have all these companies announcing all this CapEx, again, acting like cuts are not only on their way, but they are here.
And the Senator of Morgan Stanley looking ahead to CPI next week. This phrase stands out. The descent begins. We'll see. Much more on that a little bit later in the program. Equities at the moment on the S&P 500 positive by 0.4%. There is a lift in this equity market. In the bond market, yields just about unchanged on the session, but down big time over the last week. On a 10-year, 4.4512 in the FX market. A euro not doing much at all. 107.77. Coming up this hour, Larry Adam of Raymond James as stocks look to make up on April losses. John Lieber of Eurasia Group as Israel responds to threats from President Biden. And Dan Ives of Wedbush with the White House expected to impose new tariffs on EVs out of China. We'll catch up with Anne-Marie down in Washington in about 10 minutes' time. Let's begin with our top story. US stocks looking to erase April losses. The S&P 500 less than 1% from all-time highs. Larry Adam of Raymond James with this to say. We believe equity momentum is likely to continue in the long run because we are in the early stages. We are 1.5 years into this bull market versus the average of 5.5. Larry joins us now for more. Larry, you and I have talked about this theme before, and it stands out every time we talk. We've got to bring it up again. Why you believe we're in the early stages of a bull market at a time where a lot of people are looking at the economy and calling it late cycle.
No, I still think we're early because I do think that the Fed is going to cut rates before the end of this year. I think they'll take out some insurance cuts, which will elongate the recovery that we're in, and that will ultimately set up this bull market to last for years to come.
5,200 seems to be at the epicenter of your thinking. What is special about that level?
You know, that's our guiding light. When we get above that, at least in the near term, we tend to turn a little bit more cautious. If we get below that, we tend to get a little bit more optimistic. And as we had that pullback over the last, couple of weeks, that was a time to, maybe put a little bit more money to work into the equity market. But I think going forward, the risks are more balanced, as you mentioned. As we sit here right now, some of the bad news is good news. At some point in time, that bad news turns to bad news. So I think the Fed will come out, cut rates, and make sure we do, again, elongate this recovery.
Okay, so if we're at / slightly above 5,200 right now, Larry, are you in that more cautious mode at this moment?
Yeah, I mean, we've gotten more cautious over the last couple of weeks as it started to rally. I think selectivity becomes much more critical at this stage of the game. You want to be in the sectors that have the best earnings growth. And that's why, if you look at our favorite sectors, we still like technology. We like industrials, and we like healthcare because those have the most sound earnings growth going forward and the best visibility.
Well, the weird thing is after that 5% pullback, Larry, and here we are again, as John said, less than 1% away from new high. The thing that led us there was utilities. Utilities are up something like 8% in the last month when the S&P as a whole over the last month is pretty much flat as a pancake. That is a safety sector you would not think would lead you for the next leg of the bull market. So something going wrong then.
No, look, I agree with you. If you look at the leadership, as you just mentioned, over the last month, it's been the defenses, it's been utilities, it's been consumer staples. What has lagged has been the more cyclical sectors. It's been energy, it's been materials, it's been consumer discretionary. That's a message from the market that this economy is starting to slow. I think the Fed should take note because they have the ability to do something that very few Feds have been able to do, and that's actually engineer the very elusive soft landing that everybody talks about. I think they need to take note of that.
Larry, what about the data next week? What will that change in your call for there to be cuts? What do you need to see to guarantee that we are going to get those insurance cuts you think the Fed is going to deliver?
I think we need to start to see the actual data reflect what's actually happening on the surface of this economy. So when we see CPI next week, hopefully we'll start to see those rental parts of CPI starting to decelerate, because that's really been the one linchpin that's really kept us elevated. Hopefully, we'll start to see that move lower in the direction that we're looking for. That'll start to give the Fed the ability to put less focus on inflation and turn its sights onto this economy to make sure, as I mentioned, they can cut.
Larry, let's not forget retail sales or jobless claims either, particularly after the read that we got yesterday. This is what Andrew Hollenhorst has got to say. Companies are conserving on labor costs by slowing hiring, cutting working hours. Small business hiring intentions have dropped to multi-year lows. He goes on to say individuals are becoming more concerned about finding a new job and are quitting at lower rates. Are we at risk here of a sharper weakening in the months to come?
I think we are seeing a slowdown. Let's keep in mind that 175,000 jobs that was created, that's just slowing. That's a normalization. We still think you're going to continue to see positive job growth for the remainder of this year, but it is going to slow, right? I think we've gotten, lulled into thinking that you need to get, above 200,000 every month. That's really not normal for this economy. Somewhere around 100, 125 would still get us to a soft landing going forward, but it is something to keep an eye on.
Against that backdrop, where do you think earnings growth comes from?
I think it's the sectors that we talked about. If you look at what's happening right now in this earnings season, it's the areas that tend to be more dedicated to business spending as opposed to consumer spending. And you're going to get the best results in technology, industrials, and healthcare. Those are the areas that I would continue to see earnings growth.
We saw that in the cloud spend, Larry, from the big players, that's for sure. Just reinforcing everything you're saying. Can we talk about the consumer a little bit going into next week? We'll hear on Tuesday from Home Depot, Walmart on Thursday. Really mixed stuff on the consumer. Danny and I were talking about that yesterday. Theme park business at Disney, pretty decent, but the read you get from McDonald's, from Starbucks, there's some warnings out there, Larry. How much weight do you put on either company?
Well, look, the consumer is the biggest part of the economy. So it's critical to get the insights of what these companies are saying. You know, one of the things that we've been watching for, you know, we've had restaurants previously, and the consumer is starting to be challenged, right? Restaurant tends to be one of the harbingers, first areas that consumers start to pull back on. And when you look at restaurants specifically, it's which companies can actually convey their value-oriented menu. I think when it comes to these companies that you're talking about coming out to report, that are going to report, are they providing the consumer with the low cost, the value to have them come into their stores? That's a story that we're going to continue to watch. Our consumers dipping down, looking at more value-oriented generic products as an example. Those would be some of the stories and dynamics that we'll be looking for.
Larry, is that even enough? Because I wonder how strong the trading down narrative is this time around when you have someone like McDonald's, which, let's be honest, is the most value of value you can get when it comes to any food, warning about the consumer. When you have Amazon saying that they also see consumers feeling the pinch, when you can get a lot of cheaper generic stuff on Amazon, is the trading down tendency not as strong this time around?
So it's strong. I agree with you that the consumer clearly is slowing, but I don't think they are collapsing. You have to remember that consumer wealth is at an all-time record high. When you look at the jobs still being created, that creates cash flow for consumers to spend. But it's okay that they start to slow, but they are starting to prioritize what they're spending on and being much more frugal in the areas that they're spending. But the ones that do offer that value are the areas that I would continue to look for to succeed in this market.
Okay, going back to the other side of this coin that you like, the big tech players. We're going to get NVIDIA earnings on May 22nd. As we were discussing, Larry, it hasn't been tech that's led this rally. Does NVIDIA change that?
Well, I don't talk about specific companies, but I do think that this AI trade is in its early stages. And I think when you even look at some of the big players haven't really even announced their strategy when it comes to AI, that'll be another catalyst for that particular theme going forward. And I think one of the biggest things that I've taken away from earnings season is that the profitability of these tech companies is fantastic. They're the most profitable companies in the world. And what are they doing with those profits? They're investing in the future to make sure they can keep their competitive edge when it comes to driving those earnings. And with those earnings, they're doing two other things when it comes to shareholder value. They're either initiating or increasing their dividends, and they're doing buybacks. And both of those also serve as tailwinds for the sector.
Larry, it was great to catch up. Larry Adam there of Raymond James. Can't speak to single names, but that is the only name we'll be talking about on May 22nd, shortly after 4 p.m. NVIDIA. Let's talk about the consumer, Danny. I want to go to what Dana Peterson had to say over at the conference board. Confidence retreated further in April, reaching its lowest level since July 22. Consumers became less positive about the current labor market situation, more concerned about future business conditions, job availability, and income. That speaks to the consumer franchises that you named.
But the weird thing about that, though, is even if there's a consumer who is not very confident, more concerned about jobs, the savings rate is somewhere around 3% right now of disposable income. I just don't understand that, John. If you are worried about the world, about your job, presumably you would save money. That's not what we're seeing. They are spending. Again, it comes to the contradictions we're seeing in the data and the anecdotes.
Let's see if we get more contradictions next week, getting you set up for a major week just around the corner. Equity futures right now going into the weekend positive by 1/3%. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Shanali Basak. Hey, Shanali.
Hey, John. The UK bounced back from a shallow recession to post the strongest quarter of growth since late 2021. GDP jumped 0.6% in the first quarter, higher than economists had expected, and the data marked the end of the mildest UK recession in almost 70 years. But it could complicate the Bank of England's rate cut path with potentially stronger growth feeding inflationary pressures. And Bloomberg News is reporting that UBS is considering introducing a reward system for investment bankers who refer clients to the firm's wealth management business. Some bankers would likely be in line for payouts when they successfully attract new money to the lender's private banking unit. And the referral fees would be a first for the Swiss lender, echoing earlier incentives that Credit Suisse had offered to its deal makers. And Apple has issued a rare apology for touting its latest iPad in a certain ad. The commercial shows musical instruments and other creative creative tools being crushed, drawing criticism on social media for what many are calling the depiction of the destruction of humanity. The Apple Vice President of Marketing Communications telling Ad Age, quote, "We missed the mark with this video and we're sorry." Apple says it won't air the ad on TV as planned. And that's your Bloomberg Brief, John.
Shanali, thank you. I think we've all got stuff to say about this. Dan Ives does too. If you're apologizing for the ad, I think you're apologizing for the product.
Yeah.
Because that product is basically what that ad is.
It's about creative destruction, and that's literally what I mean, people take stuff too seriously. Apple isn't going around taking a sledgehammer to guitars.
I have to say, I watched the ad before I saw the headlines.
Right.
Didn't feel anything. Read the headlines, watched the ad. I was like, I can see it, but really?
Yeah.
And I feel like a lot of people have seen the headlines and now watched the ad.
Yeah.
And now criticize the ad.
That's true. You know, you kind of have that bias of what other people are saying.
Back to front. But if you can afford a $110 billion buyback, you can maybe direct some of that money to ad spend and avoid some of these mistakes, if you believe they are mistakes. Equities right now positive by 1/3%. Dan Ives coming up a little bit later. Up next on the program, Netanyahu vowing to fight alone.
I've known Joe Biden for many years, 40 years and more. You know, we often had our agreements, but we've had our disagreements. We've been able to overcome them. If Israel has to stand alone, we'll stand alone.
We'll catch up with Anne-Marie down in Washington. Up next on the program, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Live from New York City, welcome to the program, taking you into the weekend alongside Danny Berger. I'm Jonathan Ferro. Bramo's taking a long weekend. Anne-Marie's going to be with us in Washington in just a moment. Equity futures on the S&P 500, positive by 1/3%. Yields just about unchanged on a 10-year, 444.92. Under surveillance this morning, Netanyahu vowing to fight alone.
I've known Joe Biden for many years, 40 years and more. You know, we often had our agreements, but we've had our disagreements. We've been able to overcome them. I hope we can overcome them now, but we will do what we have to do to protect our country. If Israel has to stand alone, we'll stand alone.
So here's the latest. Israeli Prime Minister Benjamin Netanyahu vowing to continue the war in Gaza with or without U.S. support. And President Biden getting pushback on Capitol Hill. Senator Mitch McConnell saying, quote, Biden cannot have it both ways. He cannot claim his support for Israel as ironclad while denying Israel precisely the weapons they need to defend themselves. Let's head down to Washington, D.C., where Anne-Marie is joined by John Lieber of Eurasia Group. Morning, Anne-Marie.
Good morning, John. And not only is John Lieber now at Eurasia Group, but he also was a former top policy advisor for Senator Mitch McConnell, who we just heard from there. I want to first talk about the division, not just of the foreign policy hawks. We saw McConnell and Biden actually stand side by side in a lot of issues when it came to Russia, sometimes when it comes to the Middle East. But the growing division we see with Benjamin Netanyahu and this administration, how big is that gap now?
I don't think these two guys like each other all that much. That's pretty clear. There's personality differences and there's big policy differences. And even before October 7th, you had a lot of the American supporters of Israel who were not big Benjamin Netanyahu fans. And now, over the last 6 months of this bloody offensive into Gaza, Israel's become a very big political problem for President Biden, and it's starting to impact policy. And just in the last week, we've seen the Biden administration really shift quickly on its views of how supportive it is of Israel. They say that they're going to keep sending weapons and give Israel the right to defend themselves, but they're just now starting to do what the far left has wanted them to do for a while, which is condition aid, military aid going into Israel on conditions on the ground.
We heard from Senator McConnell. Lindsey Graham also yesterday was quite feisty when it comes to how this administration is conducting itself with Israel. The Wall Street Journal editorial board this morning talks about how it was the Democrats for months pushing the Republicans to sign up for more aid, and now they're the ones that don't want to send the weapons. So we have that divide between Israel and this administration. But what's the divide like in Washington between some of these Republican foreign policy hawks and the Biden administration?
Yeah, I think the interesting divide isn't the Republicans and the Democrats here. I mean, the Republicans clearly benefit from criticizing Biden at every opportunity they can. They clearly want to align as much as possible with Israel and be the pro-Israel party. What's more interesting to me is you've got senators like John Tester from Montana, Democrat running for a re-election in a race he's probably going to lose, saying that he does not support what the Biden administration is doing and declaring his ongoing support for Israel against the wishes of the Biden administration. So that divide is a really big one, and it's not just across party lines.
This comes as they're trying to really walk this fine line because of the pushback they're getting from the progressive left, and also the protests on the ground, and also the fact that they are concerned about this densely populated area in Rafah and what these type of bombs would do potentially to civilian casualties. When you lay that all out, though, what does this mean in terms of their off-ramp? Because Bill Burns already left Cairo. There's no hostage negotiation. How do they have an off-ramp, this administration, from this crisis?
The administration doesn't. The only off-ramp here, the Israelis have been really clear about this, is that they need to succeed in Gaza. They need to achieve their military ends, and they need to rout out Hamas. Now, that's not going to be easy, and an operation in Rafah won't be the end of that, because even after they do whatever they think they need to do in Rafah, they're going to probably have to be fighting an insurgency in Gaza for the foreseeable future. And there still looks like there's no plan in place for how to govern the area once the military has withdrawn, which means that Israel is going to be involved in this conflict for a long time, potentially years to come. And that means the Americans are going to have to make this choice about how much aid they're willing to supply and what weapons they want to give the Israelis to fight this war.
Given this is going to go on for months and, as you say, potentially years, what does this mean for this administration in terms of policy heading into the election? How much tougher do you think they'll get in terms of rhetoric and action on Israel?
So just today, we heard about this report that could be released from the administration criticizing the Israelis for human rights violations in Gaza. That itself would be a big rhetorical step up, which on top of the threat to withhold weapons suggests that there's an accelerating split between the White House and Netanyahu, which is the Israelis are signaling is not a problem for them. They're going to continue to fight this offensive, but it is a big problem for Joe Biden, who has this massive split within the Democratic Party, has been acting somewhat indecisively on the issue, saying he really supports Israel all the way to the end, and then now pivoting a little bit to maybe say, no, there's limits to our levels of support. That's a huge political vulnerability, and he's going to be on his back foot for the remainder of the 6 months of this presidential campaign he's got to fight.
That's what Axios is talking about this morning. Some of these big donors within the Democratic Party saying to the administration, you say you're ironclad, but we feel like there has been a shift in terms of your policy on Israel. We also have a Bloomberg scoop overnight that this administration next week is planning on finally coming out with, they've been signposting now for months, higher tariffs on Chinese EVs. What else can we see them pull, levers they can pull before the election?
Yeah, I think this EV story is actually a pretty big one. I mean, if you look at the two of the big battleground states, is Michigan and Wisconsin, which are traditional hubs of the auto industry, heavily unionized auto workforces there. And Donald Trump has been pretty explicit that on the attack, that Joe Biden's electric vehicle subsidies and the IRA are hurting these auto workers. So Biden, by putting out this 301 investigation, gets his chance to say, no, I don't like China in this country. I don't like all this Chinese competition. And I'm going to make sure that all the electric vehicles are made here in the United States. There's a lot of programs like this. You got student loan forgiveness is a huge, huge theme of the administration leading up to the campaign. But this EV is going to be a big vulnerability for them.
When it comes to the EVs, do you think it's the economics, the fact that even the Europeans are also complaining about all these cheap Chinese products are being dumped on their markets, or do you think it's politics? The Trump campaign is almost forcing their hand.
Well, Gina Raimondo called these Chinese electric vehicles iPhones on wheels. And basically, the idea is that they have so much information they're gathering about everyday Americans who drive around in these cars that the U.S., like we've seen with TikTok, does not want that type of information getting in the hands of the Chinese Communist Party. So I think there's both an element of politics and policy here. And right now, the Chinese EV share in the United States is basically non-existent. And I would be shocked if either administration allowed that share to grow at all. So,
well, that's the other question. Why do they need higher tariffs? It's already 27.5%.
Yeah, it's not the EVs themselves that are the big problem for the U.S. right now. It's the components. And one of the big geopolitical concerns as the U.S. is trying to push a green energy transition is that China ends up dominating the green energy supply chain, whether that's batteries or critical minerals or solar panels or whatever the components are that the U.S. right now is deeply subsidizing through this very aggressive industrial policy. Their goal is to make sure that this is not only an industrial policy, it's a reinvestment in America. They want that money to stay here, and they don't want any of that money going to China.
John Lieber, thank you so much for your time this morning. John, of course, that was John Lieber of the Eurasia Group and former policy advisor to Mitch McConnell. And you heard it there. I mean, these stories are going to continue until the election. When it comes to the EVs, potentially we'll finally get those details next week.
We expected this, didn't we? AMH, don't go anywhere. We need to talk more about it. If you just caught the tail end of that conversation, exclusive reporting from our colleagues here at Bloomberg, Josh Wingrove, Jennifer Jacobs, Eric Martin. According to people familiar with the matter, President Joe Biden's administration is poised to unveil a sweeping decision on China tariffs as soon as next week. We've been waiting for this one, Danny, for weeks, if not months now.
Yeah, we have, because in the build-up to the campaign, it does two things. One, it's the rhetoric of who's stronger in China, Biden or Trump. And then also it's something that the United Auto Workers have been complaining about. So this also goes to Biden's union vote, too.
What does this mean for Tesla? We'll catch up with Dan Ives of Wedbush in just a moment. He'll join us after the commercial break. We'll talk about Tesla, EVs out of China, the competition there, and we'll have a conversation about Apple, the Apple iPad. At a commercial, was it really that bad? We'll get the official review from Dan Ives himself in just a moment. Equity futures on the S&P 500 positive by 1/3%. It yields just about unchanged going into the weekend. 444.92 from New York. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Heading towards 3 weeks of gains on the S&P 500. Check out the Nasdaq, positive again by 0.4%, on a Russell up by 0.5%. If you take the sector breakdown, Danny, I'm so pleased you brought this up. Utilities, what is it about?
I've heard someone say, oh, it's an AI play. I mean, come on. Everything these days is an AI play. But yeah, up nearly 8% this month.
Amazing. All roads seem to lead to the same theme, even when maybe they shouldn't. Switch on the board and get to the bond market. Yields lower once again for a second week on a 10-year to 444.92. We're down not even a basis point this morning. But check out the 2-year. Let me go through some levels for you. The 2-year last Friday closing at 481.60, and right now 481.29. We have been pretty anchored at the front end, Danny Berger, given we've got pretty much no data this week apart from jobless claims and new Mitch, going into a heavy data slate next week.
Yeah, how anchored are we next week? We've also seen bond auctions come through, 125 billion this week. Sure, 10-year a little bit weaker, but for the most part, the market absorbed it. But at what point does it not hurt the front end, but of course, duration, the longer end? At what point do you need more return in order to actually buy those bonds?
That's where the flexibility in the yield curve has been over the last week or so. It's all at the long end. I want to talk about foreign exchange, just how much movement we've seen in dollar yen. So last week, dollar yen had its biggest week against the dollar, going all the way back to, I think, December 2022. We had a 3% move in the yen's favor. On the same week, we also broke through 160, which is just bonkers. This week, we've had another 1.74% move, but against the Japanese yen, dollar yen at 155.73. And Danny, as you've said repeatedly, it doesn't matter what Japanese authorities say this week, the yen is moving against them.
Theoretically, this should be the week where jawboning works, right? Because we didn't have any U.S. data that would really strengthen the dollar. This should be when Japanese officials, and even Ueda himself, coming out and saying, okay, we'd look at changing monetary policy if they're one-way moves. But again, it's a credibility issue. The traders are not buying it until perhaps they see the white of the eyes of a hike from the BOJ.
155.74 on that currency pair. Under surveillance this morning, our top stories. Israeli Prime Minister Benjamin Netanyahu vowing to continue the war in Gaza with or without U.S. support. Netanyahu saying in a U.S. television interview, if we have to stand alone, we'll stand alone. The comments coming after President Biden threatened to withhold U.S. weapons if Israel continues with a ground invasion into Rafah. Our next story, another investigation into Boeing. The SEC is said to be scrutinizing statements the company made about its safety practices before and after the door panel blowout on an Alaska Airlines flight in early January. If the agency finds the company or its executives made false or misleading statements, it could lead to fines. We're down by 0.2%. Every single week, there seems to be another negative story about this company.
The thing that I can't get over is that now we have the SEC looking into Boeing, and we still don't know who's going to replace David Calhoun. We still don't have a new CEO who's going to come in. That should be job number one. If you want to alleviate some of the concerns of investors, perhaps even regulators, if they're now looking at executives specifically. Surely this is what you would do, and we are still not there.
Keep hearing 1-800-LARRY-COLB again and again and again, and we'll see. Let's turn to this story. President Biden set to impose new tariffs aimed at strategic sectors, including China EVs. Bloomberg reporting the measures come after a review of tariffs imposed by the Trump administration. People familiar with the matter saying a decision could come as early as next week. Anne-Marie joining us now from Washington, D.C. for more. AMH, we've been waiting for this. You've been waiting for this. We thought maybe it would come later this summer, closer to the election. Could we hear from them next week?
Potentially, what we're reporting here at Bloomberg overnight in this Bloomberg Scoop led by Josh Wingrove, one of our reporters on the ground, John, is that it can come as soon as Tuesday. And this would go into some strategic areas the administration has talked about when it comes to this competition with China and the concerns also of national security. And most notably, it's the EV sector. But remember, around this time last month, we spoke, you and I, to Catherine Tai, the U.S. trade representative. And she said, quote, they were coming soon. The issue, of course, Jonathan, has been the fact that the trade rep has been going over these tariffs from the Trump administration that were enacted in 2018 since 2020. So what we heard from John Lieber there is that he feels like the administration has been on the back foot. Why did it take so long? But we do know that it's potentially coming next week. They've gone to great lengths, this administration, to signpost it, but we're still waiting to hear on exactly what these details are. Remember, it's hard to buy a China EV in the United States now. You can't. They don't sell here. And the tariff right now is north of 27%.
So is the symbolism enough then, Anne-Marie? Is it enough to convince voters that Biden is the choice if you're a China hawk?
Well, that's on the political side. And John Lieber really feels like part of that is that the Trump administration pushed Biden into this. I think one thing is for certain when we get the details of this and you see the direction of travel of this administration, whether it's export controls, whether it's more tariffs on China goods coming into the United States, most notably EVs and some of the components that go into them, it is clear to China and the rest of the world that whether or not we get Trump or Biden in the White House next year, you're going to get a very similar policy direction when it comes from what Washington is doing and their concerns for Beijing. And by the way, we've heard from Beijing, and this is one of the quotes I'd like to bring you. Quote, instead of correcting its wrong practices, the U.S. continues to politicize economic and trade issues to further increase tariffs is to add insult to injury. So that's the response overnight from Beijing.
AMH, stay close. We'll catch up with Anne-Marie in the next hour and much more on this story as well. The reporter behind the story, Josh Wingrove, joining us in about 1 hour and 10 minutes' time. With us around the table, Dan Ives, who covers Tesla and General Motors for Wedbush. Dan, good morning to you.
Great to be here.
If the barriers go up, if the wall gets a little bit higher for Chinese players, do the Chinese do the same thing to U.S. players?
That's the worry, right? I mean, the retaliatory is the last thing that you need from a Tesla perspective. And I think this is something everyone's been waiting for, because the reality is, given the prices of the Chinese EVs and what I've seen firsthand, it would be very tough from a competition perspective. Retaliatory definitely could happen. This Game of Thrones continues to play out.
You mentioned a product. Can we talk about that a little bit more? I don't think enough is said about that. I think a lot of people often consider Chinese products to be cheap imitations of maybe U.S. innovation. Are you seeing that out of China? How good is the product?
I mean, BYD is special. I mean, so, and I think I think from a competition perspective, Tesla's seen that in China. I still view it as there's going to be many winners there. But when you look at BYD, you look at NIO and others, that comes to the U.S. That's a major competitive issue, especially when it comes to Detroit. The 313 area, has bet so much on EVs. So that you're really protecting that for Detroit as well as ultimately even for Tesla domestically.
BYD gave an interview to the FT yesterday where they basically said by 2030, we're going to be the biggest EV car maker in Europe. No one else is going to be able to hold a candle to us. Is Europe next? Is that the next risk for the Chinese EV sector?
Yeah, Europe's front and center. I think that's going to be the battleground. And look, and that's something not just for Tesla, for a lot of the German automakers and others, and Beijing has their sights there. And I think what we're seeing here is even though EVs is moderated globally, and of course that's been a black eye for the industry, it's still the massive transformation, probably the biggest one we've seen since 1950s, and that really, I think Europe's going to be the next battleground.
I would say that black eye for the industry, it hit Tesla really hard, and their saving grace was that they went to China, that Musk met with Xi, and he got these measures that seem to indicate autopilot can exist in China. So if that's taken away, what happens to Tesla? What happens to share prices and our confidence in them?
Look, and that's why Musk, 10% politician, 9% CEO. We see the same thing with Cook. China is the hearts and lungs of the Tesla growth story. When I look at FSD, autonomous, I think the first step now toward what could be, I think ultimately a golden vision now from an autonomous perspective. But China is the hearts and lungs of the growth story, and that's well known. It's been a headwind, but we do believe that you'll start to see a tailwind in the next coming quarters.
It's funny you would refer to, perhaps even allude to Elon Musk being somewhat of a diplomat, because a lot of people in America wouldn't share that perspective whatsoever. How much distance is he able to put between the view of his government and his personal views in the face of Chinese authorities?
It's a balancing act, right? But how many CEOs could fly over to Beijing and 10 hours later come back?
Very few.
And look, and I think it just speaks to that power of Musk, despite the controversy. China, him and Cook, have been able to navigate China better than any two CEOs. And that's why for Apple and, of course, for Tesla, China is a key growth engine. That's not changing anytime soon.
Let's talk about the power of the iPad and the power of Apple. Let's get this commercial up. You can play it in the background as we have this conversation. What on earth happened with this Apple commercial around the iPad?
I mean, look, obviously an apology from Apple is rare. But if you look at what they're doing here, Apple's doing what Apple does.
What are they apologizing for?
They're basically apologizing for, it's essentially showing that traditional music, traditional arcade, things that we've seen from 80s, 90s, they're basically consolidating that into the iPad. So it's viewed as maybe a shot across the bow. But look, Apple's doing what Apple does, and I think they definitely, had some controversy from this. But it's unusual for them to have to apologize.
Are they apologizing for the product, basically? Given what you've just said, haven't you just described the product?
That is the product.
So what are they apologizing for?
Look, again, I don't know. I mean, it's like Brunson apologizing for throwing up 40 on a night.
Right? Doesn't make sense.
Doesn't make sense.
Also, isn't this completely contradictory to the whole thing about Apple? The whole, we don't give the consumer what they want, we tell them what they want. What are they doing apologizing?
Look, and I think right now, given the scrutiny they're getting from Brussels, from DC, from everywhere else, they need to sort of walk the line. But look, this goes into what is going to be potentially the biggest event they've had in a decade, going into WWDC next month, where they're going to unveil AI, not just to their customers, to developers, but to the world.
I mean, what do they need to show to really get us excited about the iPad besides, a little smiley face toy being exploded? Because, I mean, I've had the same iPad probably since 2012. Nothing motivates me to get a new one. So what do they need to show up with to say, all right, an iPad cycle, it's coming?
It's about the chip. I mean, if you look, they have the most powerful chips in the world. And what they're able to do is these upgrade cycles. When you look at iPad, this is going to create an upgrade cycle, but it's happening across the whole base because iPhone 16 combined with hardware, they essentially have an AI-driven super cycle that's now going to take place over the next few years. And that's why betting against Cook and Cupertino into an AI upgrade cycle, I personally believe is a bad bet.
You've been talking about this elusive upgrade cycle for quite a while. You're smiling, I am too. We've had this conversation for a few years. It never happened. What is different about this year? And is the iPad maybe a case study for what we could see from the iPhone later on in September?
I think it's a little case study. I think, but the big thing is really going to be AI to developers to the App Store. On the services side, they're going to monetize it from a services perspective, but then you're going to have AI built into iPhone 16 and what will ultimately be iPhone 17. The difference, and we've talked about that upgrade cycle, but 270 million have an upgrade in 4+ years. That install base, as we've talked about a lot on the show, has continued to increase. And even though it's been disappointing, we could say into iPhone 15, that just ultimately gives, I think, music to the ears of the bulls going to iPhone 16 because of the technology and because what I view is AI is going to drive
I'm one of those. I'm one of those individuals. If you aggressively upgrade the functionality of this phone, I'll consider changing it. But over the last few years, there's been absolutely no reason for me to do that whatsoever. I want you to help me understand this developers conference, what we're going to hear specifically without using the letters AI, what they're going to do, what these apps are going to look like that could be on this phone come September.
Well, I think the most important thing is this is the start of an AI app store. And what that basically means is developers is they're going to build generative AI apps. Where are they going to build it? They're going to build it within Apple's ecosystem. They're going to be able to monetize. And from a technology perspective, you're going to see, I think what they're going to unveil at WWDC is going to be a historical moment for Cupertino and Cook. And that's why betting against Apple here, and I believe the risk-reward is potentially golden buying opportunity as we look at the next 6-12 months.
I think you said it twice, but we'll let it go. Dan, it's good to see you.
Sure.
Dan Ives of Wedbush, thank you, buddy. What a week for New York sports. Just fantastic.
It's
Knicks, Rangers.
1994 all over again. That's why, look, betting against Apple is like betting against Rangers and Knicks.
Okay. You think the Knicks get it done this year?
Oh, I think this is the year.
Interesting. Did you make it to the Grand Prix over the weekend in Miami?
I did not make it to the Grand Prix, but I watched the Grand Prix.
Okay.
And
You're dressed for it, Dan. You could have come straight from Miami.
look, I'm just following Farrell's lead on F1. I wasn't F1.
I know.
I was an F1 fan. Farrell combined with the Netflix. Now I'm in.
We'll talk more about it in just a moment. Dan, it's good to see you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. TSMC sales jumping 60% in April. The world's largest contract chip maker reporting sales of $7.3 billion last month on the back of sustained demand for AI, aided by a recovery in consumer electronics. The jump follows a 34% sales increase in March, with shares of the stock rising to an all-time high in April. And Target won't sell LGBTQ-themed merchandise in some of its stores during Pride Month after a backlash dented revenue last year. The Minneapolis-based retailer plans to offer the full assortment online, according to people familiar with the matter. And Target faced threats from some customers last year over its Pride merchandise in the month of June. And campus protesters at Harvard University say they will stay in their tents and continue an encampment in Harvard Yard. The school newspaper reporting that the Harvard Out of Occupied Palestine group has rejected a proposal from the interim university president, Alan Garber, to leave the yard and avoid punishment up to and including suspension. The group posting on Instagram that Garber has rejected their counteroffer that would, quote, move Harvard forward on transparency and ethical investment. And John, that's your Bloomberg Brief.
Hey, Shonali, thank you. We'll hear from Shonali again in about 30 minutes. I knew where this conversation would go. Lobster rolls. $280. Was it actually for one lobster roll in Miami at the Grand Prix?
I think that's
the
actually
F1?
two.
It's two. You get two.
It's two.
Seriously?
Thank God.
Yeah, exactly. I mean, like, look, they have to be some real good lobster rolls. You combine that with some rosé.
I'm sorry, that is absolutely ridiculous. Dan, it's good to see you, buddy, once again. Thank you, sir. Up next on the program, a busy week of data on deck.
You are seeing that impact of higher rates finally begin to filter through. I think we just need to see more data, particularly this CPI print next week, to get a better sense of it.
CPI data coming up next Wednesday from New York City. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other
authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
On the S&P 500, equity futures positive by 1/3 of 1%. In the bond market, yields just about unchanged, 445.31. Under surveillance this morning, a busy week of data on deck.
One of the things that gives the Fed a bit of confidence that, they are applying the brake in the right way is you are seeing that impact of higher rates finally begin to filter through. We're still in the early innings of seeing the data really cool, and last week had some for the bulls and some for the bears, and so I think we just need to see more data, particularly this CPI print next week, to get a better sense of
Something for everyone. Here's the latest. Traders looking ahead to a busy lineup of data next week. PPI, retail sales, and the latest CPI print all on deck. Lindsay Piegza of Stifel writing this. It's reasonable to wonder whether or not the Fed is at all considering the scenario whereby inflation fails to improve or worse, continues to rise in a meaningful and persistent manner. Lindsay joins us now for more. Lindsay, let's get ahead to next week. What are you looking for from CPI?
I think we continue to see very frustratingly, stubbornly high levels of inflation. Price pressures in terms of the consumer still moving around 3.5%, 3.6%, with producer prices continuing to move further above that 2% threshold. So the Fed and investors alike are looking for meaningful reprieve in inflation, but unfortunately, I think they're going to have to continue to wait for some time longer.
Lindsay, can you build on that? Could you sort of break up and divide what's happening with goods prices and what's happening with services prices and how different those trends have been over the last few months?
Well, services is really where we've seen the vast majority of the pressure, with labor costs obviously the largest component on the service side, continuing to elevate this persistent and rising trend. Goods inflation, excuse me, still remains the most beneficial component of the inflationary story. But with international risks, I think still to the upside, goods disinflation or outright deflation may begin to soften that contribution to the improvement that we've seen. And in fact, if you think about it, the vast majority of the gains that we've seen in the inflation picture have come from variables outside of the Fed's purview. Economies coming back online, trade lines reopening. So should we see some of that improvement reverse course, I think we could exacerbate some of this elevated inflationary pressures that we've been seeing since the start of the year.
Lindsay, one of the arguments of CPI coming in softer next week, this is something that Ellen Zettner and her team over at Morgan Stanley make, is that rental inflation is going to be coming down, that finally the lag that we've so long been calling is going to catch up, and that's going to help CPI. Does that argument miss something?
Well, I think the timing might be off. We've been talking about this reprieve coming from shelter costs for the better part of the past 2 years, which has failed to materialize. As we continue to see housing demand outpace housing supply, I do expect the shelter costs to still remain quite robust for the foreseeable future, as we do expect the Fed to keep rates at these elevated levels. Now, there have been some pockets of reprieve in terms of rental prices, but we've also seen a lot of these repricing, so existing leases coming back online at 30, 40, 50% resets in some of these more concentrated areas. So I'm not yet convinced that we are seeing broader-based reprieve or broader-based lessening of pressure in terms of shelter costs, at least not yet.
And Lindsay, this gets back to what John started on, what you said, this idea, is Powell considering the scenario where inflation does